All right, guys. Now let's continue with the examples. Okay. So we were discussing the most important concept, that is fixed to fixed test. I explained you the concept. Right now you would have a basic idea. Now we just need to continue with the examples to get absolute idea. Okay, 100% crystal clear clarity. Now let's start with the first example. Case number 1. Company A issues a contract where investor prepays 1 lakh today. So which means already company has received 1 lakh. Investor has given that sort of a money or raised money through debentures. Okay, so which means company has given debentures and in return investor paid 1 lakh to the company. Okay, so for rupees 1 lakh, after 6 months the company will issue exactly 1000 shares. So what do you mean by that? Instead of redeeming debentures, okay, because you have to pay the principal, right? Initially you'll pay interest, after that you have to repay the principal, but instead of repaying the principal, what you will do is that you will issue equity shares, right? How many equity shares are you going to issue? Exactly 1000. Now, so we have to do fixed to fixed test. Now, tell me one thing. What did I say for fixed to fixed test? Both sides of the coin, it should satisfy, right? So from our side, we are the company. Always we are the company, okay? So don't get confused with respect to that one. Always we are the company. So from our side, how many shares? 1000 shares. Is the number of shares are fixed? Yes. Test passed. From their side, they have to give what? Fixed amount. From our side, X shares, where the number of shares is fixed. From their shares, from their side, Y money. Correct? This is what we have seen in the example. So from their side, is money is fixed? Yes. So both sides of the coin, the fixed to fixed test is satisfied. So fixed price 1 lakh, which is already be paid from their side, from the investor's side. From our sides, the number of shares is fixed, which means is fixed to fixed test is passed? Of course, yes. Got the point? The reason is very simple. Both of them are fixed, and moreover, there are no future cash flows. Okay, no variability in number of shares, just a delayed share issue. That's all. Which means today you paid money, after 6 months I'm giving you shares. That's all. So it is just a delayed share issue. Now, this mirrors share capital, so it is equity. What do you mean by mirroring share capital? Which means whatever the quality that a share capital will have, same thing is happening here. In other words, if you have issued share capital to equity shareholders, obviously the persons who buy your share capital are referred as equity shareholders, right? So what are all the qualities they'll have? They'll take the risk, okay, and they'll not have any obligation. You also don't have obligation with respect to them. Is there any obligation for you to pay an equity dividend? No. Is there any obligation for you to give them something every single year? No. Everything is discretionary. There is no obligation whatsoever. That's how the relationship between a company and a shareholder will be. That sort of relationship only we'll call it as equity. So it is like substance over form. Even though in form, sometimes you call it as preference share capital, but if the substance is in the flavor of equity, you will refer that as equity instrument only as per financial instruments. Now, if you could remember, if you could guys recollect, because one student has asked me that doubt, if you could recollect, at the beginning itself, I told you, Nana, our old AS was more about rule based, was more about form based. Okay. Even US GAAP for that matter, even today, more or less it is rule based. The scope of interpretation is much lesser. Whereas the IFRS and IAS put together is what we call it as, the international standards. That is what we have adopted. Pretty much we have copied, except for minor changes, which we already know. They are referred as carve outs and carve-ins, which we have already discussed at the beginning, right? So except for that minor changes, basically it's a copy paste. Now the point is, so this Ind AS, which is a mirror image of IFRS and IAS, is lot about interpretation. Okay, the basic concept that they follow is substance over form. Substance over form means you name it whatever you like. Ultimately, I will not look at your name, I will look at the substance. To give you a very silly example, I'm already telling you that it's gonna be silly. Say for example, I cooked veg Manchurian. I call it chicken Manchurian. You understand the point? I say it's my name, I gave it chicken Manchurian name. Now what does Ind AS say? I have to look at substance over form. So you call it chicken Manchurian, that is a form, that's the name of it. What is it actually? Veg. So therefore I'll treat it as veg, even though you call it as chicken Manchurian. Are you able to get me? I know this is a silly example, but this is a pretty blunt example that I can give you. So substance over form, this is what it means. So therefore, one of the students has asked me, a doubt saying that, sir, how can you classify something like preference shares as equity instrument? Because we look into substance over form. Okay, so we don't look at the name, that is nothing but the form. We look at the substance. I hope this is clear. Right, moving on. Now, suppose after 6 months, suppose till here it is done. Already we are done with this example. Okay. Now, suppose after 6 months, market price of the company A share is, okay, case 1, it is 120. Then the value of shares will be 1,20,000 because the number of shares is anyway fixed. Suppose in case 2, if the market price becomes 110, value of shares will be this much. In case 3, this much. In case 4, this much. So, the holder of the share takes risk just like equity shareholder of the company A by getting himself exposed to 1000 shares variable returns. Variable number of shares should not be there. Variable returns should be there. That's the quality of equity shareholder, na? He takes care of all the risk. He is an equity shareholder, which means he has bought our equity shares. So obviously, whatever the fluctuation in the market with respect to the market price of our share eventually happens, he takes care of all the risk. If it goes up, he enjoys. If it comes down, he feels bad. You understand the point? Here also same thing is happening now. So which means exactly the transaction mimics a real shareholder, equity shareholder and the company transaction. That's why this will be classified as equity. Okay. So in issuer's books, that is in company's books, company A's books, it will be classified as equity. Which one? This particular example. Even though you have raised money through debentures. See that? Look at the second example that I gave you. Intentionally, I gave you this example only to give you that clarity. It is debentures. Ah, sir, debentures debt, sir. Financial liability, no, sir. No, sir. Did it satisfy fixed to fixed test, sir? Yes, sir. Is the debentures in this case or behaving just like equity shareholders of your company? Yes, sir. So even though you call them as debentures, which is form, I would look at substance over form. Your form is debentures. That's the dress that the dress you're wearing. But what is inside the dress? It has all the qualities of a equity shareholder. Then I classify that as equity, as simple as that. You get it? Moving on. So that's our case number 1. So let's move on to case number 2. Case number 2. Moving on to case 2 now. Investor agrees to pay 1 lakh in 6 months, okay, or raised 1 lakh worth debentures, okay, right? It's similar to the previous example. On settlement, company will issue shares equal to the current market value of 1 lakh. See, the logic is you paid me 1 lakh. Me means, again, I'm telling you, by default, we are the company. The other side, it is investor, okay? You paid me how much? 1 lakh. After 6 months, I'm going to settle it. Settle it in the sense I'm going to repay you. How am I repaying? I'm not giving you fixed number of shares. I'm saying I'll repay you the exact money, which is 1 lakh. For that 1 lakh worth, how many shares will be there according to the market price on that particular date? That many shares I'll give you. Are you able to get me? Which means, tell me one thing, whatever the money that you have paid, the other side of the coin, what you have given me, is it fixed? Of course it is fixed because you have already given me 1 lakh. Whatever the kind of number of shares which I'm going to give you as a company, my equity shares, is it fixed? Nope. It will depend upon the market price per share. This 1 lakh divided by market price per share will give you number of shares, which I don't know. So it is absolutely variable in nature. Unlike the earlier example where it was fixed that I'm going to give you only 1000 shares irrespective of the market value, correct? Whereas now, what market value will make sure that exactly it will touch 1 lakh because that's what you paid me, right? So I have to repay you back 1 lakh. Only that many number of shares I'll give you. I don't know how many as of today. That day we need to wait. That day we need to say, we need to see what is the market value per share. Then we will divide it with 1 lakh and then we'll get a particular number. So accordingly, that many shares I'll give you. So is it fixed? No, it's variable in number. So therefore, the number of shares is variable. So from my side, it is not X number of shares, it is variable number of shares. So I did not satisfy fixed to fixed condition. You know that if any one did not satisfy, it's gone. Fixed to fixed test is failed. So is it passed? Nope, it failed. Because company must adjust number of shares to match the value. This is no longer equity. And one more thing you need to understand is that PKSIR says, which means I'm saying basically, because I've written it this way because when you do self-study, it will be, it's like you will feel like as if I'm talking to you. So that is the reason I've used this sort of, kind of writing notes, because my intention was when you read this power notes, when you revise this power notes tomorrow, you should feel as if I'm talking to you. You should virtually hear me. That's my anticipation. Hopefully that it works. Maybe you guys should share your feedback. So PKSIR says it's like paying debt using shares as currency. So when I don't know exactly how many shares I'm going to give you, so it's like a debt only, na? Because you gave me 1 lakh, so I am indebted to you, so I have to repay the debt. How am I repaying your debt? Not in terms of rupees, but in terms of number of shares. So in the place of rupees, shares has got replaced. Normally rupees will be the currency, but instead of rupees, I'm giving you shares. That's all. So indirectly, I'm giving you shares as a currency only because I don't know how many shares I'm going to give you. You understand what I'm trying to say? So therefore, when you're giving shares as a currency, it doesn't work. It fails the fixed to fixed test. You got the point? So therefore, it can no longer be classified as equity. So the company has to satisfy a financial obligation. Therefore, it's a financial liability. Got it? Chalo. What is a financial obligation? You have to repay this debt, na? You got the point. Repaying debt is a financial obligation. Okay. If you do that with a fixed number of shares, that's a different thing. In that case, it satisfies the fixed to fixed test because there is no obligation. You understand the point? Neither cash obligation nor amount obligation. But here you have a cash obligation because you are promising that I'll repay 1 lakh. You are not saying that I'll give you 1000 shares, I'll give you 100 shares, I'll give you 150 shares, I'll give you 1250 shares. You need to understand the concept here. I'm not saying I'll repay you by way of 1000 shares, by way of 1200, by way of 1500. No, I'm saying I'll repay you 1 lakh with how many shares possible on that particular day, depending upon the market price on that particular day when I'm going to repay you. Got the point? Now, are we done? So therefore, in case 2, it is financial liability. In case 1, it is equity instrument. Case 3, let's see. Now, company PK Limited, let me put that way. Okay. Company PK Limited raised 10 lakhs. I think it's 10 lakhs. Yeah. Through debentures. Again, debentures. Concentrate on this. Which will be converted into 1000 equity shares after 3 years. Fine. So far, so good. Okay. Because 10 lakhs, you gave me money. That is fixed from your side. One side of the coin, test is satisfied. From my side, I'm going to give you 1000 equity shares after 3 years. So far, so good. So far, it sounds like equity instrument. However, here comes the twist. It contains anti-dilution clause. What do you mean by anti-dilution clause? Okay, you'll understand that. In essence, if company issues bonus shares or share split in future, in this 3 years, to their existing shareholders, then shares promised to the debenture holders should be increased proportionately. Because in case if you go for bonus or if you go for share split, then whatever the shares that you have promised here, its value likely goes down, isn't it? You understand what I'm trying to say? Because see, simple logic, Nana. Say for example, one share ka value is 1000 as of now. If you go for shares split and you split one share into two, automatically share price will drop to 500 per share. Not exactly, but almost it will drop to 50%. In that case, earlier when you said you'll give me 1000 equity shares, accordingly the value will be 1000 into 1000, correct? But now once you go for shares split and then after that also you say I'll give you 1000 shares only, then am I an idiot to get exactly half the value? You understand what I'm trying to say? Okay, this is one aspect. The second aspect is forget about the value. Just look at the controlling power that I'll have. With the existing number of shares, let's say total shares is 10,000, Nana. Total shares of the company is 10,000. How much is the power or control I'll have? I'll have 10% control, correct? Because mine is 1000 shares. Your total number of shares in your company is 10,000 shares. Just imagine, okay? Just imagine for understanding purpose. In that case, I have a control of over how much? 10%. Now suddenly you go for a bonus and then you issue another 10,000 to everybody who has one share, one bonus will come. In that case, now the number of shares will be 20,000. And if you give me the same 1000 shares, then I'll have not 10%, right? I'll have 5%. So which means my voting power is reduced, my control is reduced. Are you able to understand? Right. So which means actually my power is getting diluted. My control is getting diluted. Got the point? So for that, I have something called anti-dilution clause. Anti-dilution clause means I try to protect myself, my voting power, my controlling power from getting diluted. So therefore, what I say is, in case if you go for share split, proportionately you increase my shares also. My shares means I'm a debenture holder right now. For example, let's say you have 10,000 shares totally. You promised to give 1000 shares. This is our agreement, correct? Tomorrow suddenly you go for 1:1 bonus. In that case, your total number of shares will become 20,000. In that case, mine also increase proportionately, which means you will give me 2,000 shares. Simple. So earlier also I had 10% control. Now also I'll have 10% control. You understand the point? Now, where students gets confused is, sir, because of this anti-dilution clause, sir, number of shares varies, na, sir. If this anti-dilution, if this share split or bonus happens in between these 3 years, then definitely the shares will become variable, na, sir, because it will not be 1,000 for sure. And therefore, sir, fixed to fixed test is failed, sir. Therefore, I will treat this as a financial liability. That is what students do usually. Well, sorry to break the news, your answer is absolutely wrong. Why, sir? It's very clear. The number of shares is not fixed. It is variable in nature. Fixed to fixed test is passed. That's why I put a question mark here. Why, sir? Because student will get this doubt. Increase in number of shares is to protect the rights of the instrument holder. Rights. I said na, control, voting rights and all that. But not to protect their returns, na. Am I protecting your return? Am I saying like, sir, right now 1,000 equity shares are there, sir, which means right now the share price is, say for example 100, sir. 1,000 into 100, so much is the value, sir. Okay, you understand what I'm trying to say? So some X value is there. Tomorrow, suppose the share price drops like 90, sir, then accordingly I'll increase the number of shares in such a way that the value that you get will be the same. Is the condition is like this? Are you able to get my point? Sir, 1,000 shares, I said I'll give you, sir, into 100 is the value of the share right now, which means totally how much is the worth I'm giving? This much. Correct? Okay, here the value is 10 lakhs. So I'll keep 1,000 per share is the market price. 10 lakhs is what I'm paying you, right? 1,000 shares, each share worth is 1,000 per share. Tomorrow, suppose share value drops to 900, I need to ensure that still I pay 10 lakhs, because if the share price drops to 900, I'll still be giving you 1,000 shares. In that case, the value that I'll be giving you is only 9 lakhs, na? So which means your investment is getting affected here, your return is getting affected. You understand what I'm trying to say? So what I'm saying is that this is also anti-dilution clause only. Now see what's happening over here. Sir, this is a different kind of anti-dilution clause, okay? Where I'm saying in case the market price drops, I'll increase the number of shares in such a way that before that, ultimately the total value I have to pay you is 10 lakhs. I'll ensure that it is not dropped. So in case my market price per share drops also, I'll accordingly increase the number of shares such that you still get 10 lakhs. For example, now market price per share is 900. Okay, how much ultimately I have to pay you? 10 lakhs. 10 lakhs divided by 900. Let us see how many shares we get. 10 lakhs divided by 900. 1111.11 share, which means these many shares I'll give you. In this case also variable number of shares only I'm giving you. Correct? Because the shares number is changing. But what is the purpose? The purpose is to protect the return of the investor, the return of the debenture holder. If your purpose, if your anti-dilution clause is to protect the return of the investor, this is very important, Nana, because this is where even some faculties, they get confused. Because there are two types of anti-dilution clause, Nana. One anti-dilution clause is to protect the investor rights, voting rights. The other anti-dilution clause is to protect the investor return. Please try to understand. This is a really confusing area where students get confused, even faculties get confused. Okay, the point is there are two types of anti-dilution clause. One where you try to keep an anti-dilution clause, in this case where you have a bonus shares or share split, where you want to protect the rights, the example which I've drawn here in blue, this is where you want to protect the return of the investor. There is a difference between an anti-dilution clause which protects the rights of the investor, or an anti-dilution clause where it protects the return of the investor. If there is an anti-dilution clause which protects the rights of the instrument holder, then fixed to fixed test is still passed, because you preserve the original ownership percentage. That 10% I told you na, that we are preserving. 10,000 shares, 1,000 shares, 10%. Now you are going for bonus, 20,000 shares, then 2,000 shares, 10%. So ultimately your 10% is getting protected, that ownership percentage. If for this purpose, if you have an anti-dilution clause, then your fixed to fixed test is still passed. No worries, you will be classified as equity only. However, I gave you one example right now, where there is an anti-dilution clause where you'll be increasing your number of shares from 1000 to 1111.11, where you try to protect the return of the investor. So if you try to protect the return of the investor, then no, that anti-dilution clause will become a financial liability. Got the point? Two types of anti-dilution clause. Please keep this in mind. Now, see here. That's what I've given here. This clarity you will find nowhere, Nana. But I've seen a problem. That is the reason I've put it over here. Okay. Many guys, they're getting confused. Anti-dilution clause is of two types: stock splits, bonus shares, reverse splits, capital consolidation. These are all the anti-dilution clause where ultimately you protect the rights of the investors and you preserve the original ownership percentage, that 10% what I'm talking about. In that case, F to F test is passed. So it will be treated as equity instrument. However, if there is another anti-dilution clause where you will issue new shares at a lower price, you understand the point? And as a result, you try to increase the number of shares, that 1111.11 which we have seen just now in an example, such that you protect the return of the investor. You protect the return of the investor. In this case, debenture holder is the investor. Okay. In that case, your fixed to fixed test is failed. Got the point? Then it will be treated as obviously financial liability, because always the fight is between financial liability as well as equity. Na. If it is not an equity instrument, automatically it becomes financial liability. There is no discussion for that. Got it? And this is also this sort of anti-dilution clause where you protect the you protect the return of the investor, return of the debenture holder. We call it as future down round pricing. There is a technical name for that, because this could be used while framing a question, because this is used in the industry. Okay, that's the reason I've written here. What is the word? Future down round pricing, where in the gap here, the gap is 3 years. Now in this gap, sometimes company will issue new shares at a lower price. So when you issue new shares at a lower price, when company itself is doing that, it will affect the market price. And eventually what will happen is that the return of the investor or the debenture holder in this case gets affected. So to protect his return, we'll give more number of shares. You understand the point? Thereby shares become variable. In that case, it is not satisfying fixed to fixed test. It will be treated as financial liability. This concept we call it as future down round pricing. Got the point? Yeah. It is not just financial liability, it will be called as derivative financial liability. That we'll see later. Right now, don't get confused, because a derivative can be a financial asset or a financial liability or a equity instrument, right? Chalo. Are we done with this? So, case 3 is an important case, Nana, where ultimately what you learn is there are two types of anti-dilution clause. One is this share split, stock split, whatever it is, where the ultimate purpose of the anti-dilution clause is to protect the rights of the instrument holder or the investor or the debenture holder in this example, or to protect that ownership percentage, the 10%. In that case, it's fine. Fixed to fixed test is satisfied. It will be classified as equity instrument. However, if the anti-dilution clause is a kind of situation where you are protecting the return of the investor, where your company is going with new shares issue at a lower price, and thereby for the existing investor you are trying to increase the number of shares such that his return is getting protected, then in that case fixed to fixed test is paid. We call it as a financial liability. So this concept is called as future down round pricing. Okay, now moving on to case 4. Any doubts with respect to case 3? Clear? Chalo. Those who are taking FR from me after taking from any other faculty and stuff like that, you will feel the difference. Those who are listening to me for the first time, probably you might not recognize it. Okay. Anyways, let's move on. Moving on to case 4. PK Limited writes a call option. Now, the moment I say writes a call option, immediately you should understand, because we have discussed the derivatives also, Nana. So call option means, right to buy. First basics, that's what should strike in your mind. Now, when it comes to call option, there are two parties: option buyer, option seller. Option buyer will have the right to buy. Option seller will have an obligation to sell, because this guy has right to buy means the other guy should be selling now. Got the point? And this guy has got right means the other guy should have obligation. So when you write a call option, it means you are selling a call option. Writing is nothing but selling. Okay. When you're selling a call option, it means the other side of the guy who is buying a call option will have right to buy. You'll have obligation to sell. You got the point? So in this case, the company has got obligation to sell its own equity instruments. That's what you need to understand. So PK Limited writes a call option towards AK Limited on its own shares, which means I have an obligation. PK Limited has got an obligation to sell my own shares, provided if that guy exercises. That is also there. So it is not like 100 out of 100 cases because it's an option, Anana. That guy has to exercise. If he exercises, I'll have an obligation to sell. If he doesn't exercise and if he lapses the option, then what is there? I'll not exercise anything. You got the point? Now, so in 3 months, right? Now see here, case 1 and case 2. I gave you 2 cases. In case 1, when PK Limited writes a call option where PK Limited has got an obligation to sell its own equity share, the so-called exercise price is fixed. You understand the point? The exercise price is fixed, which means when I have an obligation to sell my shares to you, right? My exercise price is fixed. It will never vary, which is 40 per share. If that is fixed, then fixed to fixed test is satisfied, and as a result, it will be called as a equity. Now, suppose if I say like this, you have an obligation to sell your own equity share to AK Limited. However, it depends upon the market price of your share on that particular day, on the date when the option gets exercised. Suppose the market price of the share is greater than 50, then your exercise price will be 40. Suppose market price of the share is less than or equals to 50, then your exercise price will be 30, which means exercise price is variable. You understand the point? Exercise price is variable. Are you guys able to get me? Right? Sure. If this is variable, in that case, the derivative is a financial liability. If it is fixed, then it is equity. If it is variable, then it is financial liability. Okay. Now, one more important point that you have to note here is that there is no direct accounting for derivative. This you will see in Ind AS 109. Still, we did not go there. Okay, because I told you derivative can be a financial asset, derivative can be a financial liability, derivative can be a equity instrument. So first you need to figure out what kind of a derivative it is. If it is a financial asset, that accounting will be done. If it is a financial liability, that accounting will be done. If it is an equity instrument, that accounting will be done. You understand the point? I hope it is clear. Derivative in itself has got no value, no accounting, because what is the name, Nana? Derivative. It derives value from something else. So in itself there is no value, na? Therefore there is no accounting for derivative as such. You need to identify what that derivative is: financial asset or financial liability or equity instrument. Accordingly, we'll have an accounting. Which accounting, sir? We'll see it in Ind AS 109. Okay. Which accounting, sir? We'll see it in Ind AS 109. Are we done with this? Case 4. Right. Moving on to case 5. Case 5, guys. Now, listen carefully. Very important. You have two companies, ABC Limited, XYZ Limited. Okay. Now, ABC Limited will issue 1500 own equity shares. So when the number is fixed, X number of shares, so it is fixed. How much now? 1500. It's not going to change. Right. So, okay, fine. I am ABC Limited. I am issuing 1500 equity shares to you. Sounds good. What am I getting in return? What is the consideration? Why would I give my shares freely? I am giving you 1500 equity shares of mine. What about you? Give me consideration. So the consideration is, you see the situation over here. Will buy 1000 shares of XYZ Limited. Will buy 1000 shares of XYZ Limited. Again, I repeat, will buy 1000 shares of XYZ Limited. Sir, what do you mean by buying? You will not understand this. Let me frame this sentence in a different way. ABC Limited will issue 1500 own equity shares to the other guy means indirectly they are selling only, na? I am selling my shares, na? So in return, what I am doing? I am buying your shares. You got the point? But the problem in this is you have to buy 1000 shares on a particular date. When you need to buy? After 3 months. On a particular date, you have to buy. Okay, fine, I'll buy. I'm already selling you 1000 shares, 1500 own equity shares from my part. That's okay because it's my shares, na. So I'm going to give you 1500 equity shares in the form of paper documents. Let's say I'm giving it to you. So that is fixed. Fixed test is passed. But from your side, you are saying that for that, the consideration that you are giving is I have to buy your shares. Okay, right? 1000 shares I need to buy. But what is the situation over here? At what price? That is not fixed. 1000 shares is fixed, but the price is not fixed. Now here again students will get confused. You know how they'll get confused? Sir, number of shares is fixed now, sir. Therefore, fixed to fixed test is passed. Arey yaar, number of shares fixed is from our perspective. Our perspective. What is that, sir? Our perspective means our company. Who is us here? ABC is us. You got the point? So from my perspective, if number of shares is fixed, then that is fixed to fixed test passed. Not from the other party's perspective. You understand what I'm trying to say? Here, this 1000 shares which you are thinking that it is fixed, it is shares of this fellow, Nana, XYZ. You understand the point? Other fellow shares. So there you cannot apply that fixed to fixed test. You understand the point? Always you try to remember the fixed to fixed test. From my side, X number of shares. From the other side, Y amount of remuneration. Y rupees of remuneration. Did I ever mention that from other side also Y number of shares? I never said that. From our side, X number of shares. From their side, did I say Y number of shares? Then X number of shares, Y number of shares, fixed to fixed test is passed? No. X number of shares from our side. Y amount of rupees from the other side. Y amount of rupees from the other side. Consideration should be fixed in rupees. From my side only, number of shares should be fixed. Now tell me, from other side the consideration is fixed? No, it is not fixed. On that day, how much will be the share value based on that into 1000, whatever the price is there, you have to eventually buy. Here anyway, you're selling now, you're getting money. You understand the point? So that is the consideration you are getting for your shares. This guy is paying, and in return, you have to buy his shares. So you have to pay. Are you able to understand the transaction over here? But this is where again students get confused. Why? Because that's why they say financial instruments is difficult. Actually, it is not difficult. You just need to understand the concepts in a clear way. In that case, it should be easy chapter. Will buy 1000 shares of XYZ Limited. So the rule, X number of shares I will give. Y amount of rupees you give. That is fixed to fixed test. X number of shares I'll give. Y number of shares you will give. Is that the fixed to fixed test? No. Fixed number of shares will only apply for me, for my company. I'm giving my number of my shares. You understand the point? Not if I'm going to buy your shares. Got it? There the consideration should be fixed. Here consideration is not fixed. Therefore, fixed to fixed test is filed. Therefore, it's a financial liability. Got it? Yes? Any doubts so far? Before we go to case 6. Any doubts? Okay, clear sir, clear sir, clear. Everybody respond. Alright guys, so which means, okay, you guys are clear. Anyways, now let's go with case 6. ABC Limited rises 10 lakhs through 10,000 debentures at 100 each that are convertible into equity shares. That's fine. He has paid me 10 lakhs, the investor, to me, I'm the company, right? So the consideration is fixed. One side of the coin, fixed. Now what about me? How many shares I'm going to give? Is that fixed? Okay. 1:2 at the end of year 2. Okay. So if I'm going to give shares at the end of year 2, it will be 1:2. All right. Which means for each debenture, I'll give you 2 shares. That is the meaning. Suppose if I'm going to give it at the end of year 3, then it is 1:3. Suppose if I'm going to give it at the end of year 4, then it is 1:4. Got it? So what you have to understand is that even this is also fixed. Now you can say, sir, how is that fixed? Because here the number of shares are different. Probably you'll be giving 20,000, here 30,000, here 40,000. In that case, the number of shares is also variable now, sir. No, it is not variable. Time is changing. I'm going to redeem only once. Either year 2, if I'm redeemed it in year 2, then this and this are irrelevant, na? You understand the point? Suppose if I have not redeemed in year 2, then I'll redeem it in year 3. There also the number of shares is fixed. Already it is fixed. It's gonna be 1:3. Suppose I don't redeem over here, then here I'll redeem. There also the number of shares is fixed. So you better see these 3 instances as separate questions. Got the point? In that case, you'll convince yourself that, okay, fine, this is fixed. So this is also fixed. They are variable with the time, not because of the market price. See, here I'll give 20,000 shares. Here I'll give 30,000 shares. Here I'll give 40,000 shares. Am I doing this because of variation in the market price of the share? Am I doing this because I'm trying to protect the return of the investor? No, nah. Because of the time, things are changing. So when you're gonna redeem, depending upon that, if you redeem early, less number of shares. If you redeem more number of shares. I mean, if you redeem late, more number of shares. You got the point? So therefore, time is certain and not like market price, which is uncertain. Here with respect to time only, this is happening. So therefore, FTF test is passed. So it is still equity. This is not contingent, Nana. We are not trying to say, because time is certain to happen. Na? Year 2 will come for sure. Try to get to the logic, Nana. Try to start thinking. Year 2 will come for sure, no matter what. Year 3 will come for sure, no matter what. Year 4 will come for sure, no matter what. This is not a contingent issue, Nana. I'm not saying if war happens, then I'll give so many shares. If war doesn't happen, I'll give you so many shares. You understand point what I'm trying to say? So that is a contingent issue. Then things are different. I'm not talking about contingency over here. This is not a contingent thing. Time is certain to happen. Time will happen for sure. No matter what, year 2 will come. No matter what, year 3 will come. No matter what, year 4 will come. And any one will happen out of the 3. All the 3 will not happen, obviously. Right? So depending upon when you are going to redeem, earlier, less number of shares. Later, more number of shares. And time is certain. It is not contingent. It will happen for sure. Therefore, fixed to fixed test is passed. So, debenture holders may exercise conversion at the end of second year or third year or fourth year. But the number of shares with respect to the time is already fixed. You can only redeem only once, Nana, either second year or third year or fourth year. That's all. It's not like second year also I'll do, third year also I'll do, fourth year. No, no, no. It's not that. Second year you're doing, fine. Third and fourth is automatically eliminated. Third year you're doing, already second is eliminated. Fourth will automatically be eliminated. Fifth you're doing, then already second and third are eliminated the moment you come to the last year. You understand the point? Sorry, fourth year. Automatically second and third are eliminated. You get what I'm trying to say, right? So ultimately the number of shares is fixed. Chalo. Now this is different. Look at this. Case 7. Here, PK Limited issued rights call option. Rights call option means what, Nana? The other guy would have bought the call option, so he has got right to buy. We have written the call option, we have sold the call option, so we have obligation to sell. Obligation to sell means obligation to sell or issue our own equity shares, right? Okay, on its own equity shares at an excise price of 50. Excise price is fixed only, fine. Then what else? 100 shares I will sell. I have an obligation to sell. It will be 100 in number. If profit in year 1 is greater than 10 crore, okay. It will be 200 in number if profit in year 2 is greater than 30 crore. It will be 300 in number if the profit in year 3 is greater than 40 crore. Alright. Now, how should I analyze this from fixed to fixed test point of view? First one, each of these are conditions, correct? Check whether they are dependent or independent, which means this condition is dependent on this condition is dependent on this, something like that. No, this is independent, this is independent, this is independent. You got the point? Suppose in year 1, your profit crossed 10 CR, then you will give 100 shares. Then it's a matter. It doesn't matter what's going to happen in year 2, doesn't matter what's going to happen in year 3. Suppose in year 2, 30 crores you have crossed, you will give 200 shares. If it did not cross, you will not do anything. Suppose in year 3, if it crossed 40 crores, then you will give this. You understand the point? Each and every condition are independent to each other, which means again, you see this as 3 separate instances, 3 separate contracts. So each contract has got fixed number of shares, just like here. So because each contract has got fixed number of shares and the conditions are independent to each other, still fixed to fixed test is passed. Therefore, this will be classified as equity. Now, don't stop. Let's continue so that immediately your doubt will be cleared. I know what kind of doubts are coming to you. Okay, immediately it will be clear. Now see. Same question. However, look at the conditions. 100 shares if profit in year 1 is greater than 10 crore. 200 shares if profit in year 1 only will be greater than 30 crore. 300 shares if profit in year 1 only is greater than 40 crore. Sorry. Now tell me, here in first year only you are having 3 choices, na? Here that is not the point. With respect to time, fixed number of shares. 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 With respect to year 2, fixed number of shares. Year 3, fixed number of shares. Year 2, fixed number of shares. Year 3, fixed number of shares. Year 4, fixed number of shares. Whereas year 1, fixed, no, variable. At least now are you able to get the difference? Now you are able to get the difference, right? Moreover, here the conditions are dependent on each other. Because once you have crossed 10 crore, doesn't mean that you won't cross 30 crore. If you also cross 30 crore, then there is no question of 100, it will become 200. Also, you can cross 40 crore, then it will become what, 300. So, conditions are dependent and linked to one another. So, basically, it is one contract only. Like this, we can't call it as a 3 contracts. It is one contract in year 1 itself. Therefore, you have variable number of shares scenario. It can be 100, 200 or 300 in year 1 itself. Here, that is not the case. Year 1 means 100 only. Year 2 means 200 only. Year 3 means 300 only. Year 2 means 20,000 only. Year 3 means 30,000 only. Year 4 means 40,000 only. I hope you are getting the difference, right? So therefore, here fixed to fixed test is not satisfied. Therefore, it is a financial liability. Okay. Note, all above examples are questions from ICA study material. This anyway you guys know, but anyway I have written here. Okay. So what is the simplification? PKSIR hack. Whenever you get consideration, who will pay? The other party will pay. The other party will pay. Other side of the coin. Value should be fixed but not number. So amount should be fixed. Y amount, Y amount, Y amount. Amount should be fixed from the other side. From our side, shares number should be fixed. Number should be fixed and not value. From your side, value should be fixed, not number. From my side, number should be fixed, not value. If you can figure this out, if you can just remember this sentence, fixed to fixed test is done. You will not be confused in any sum. Got it? From my side, number should be fixed. Value need not be fixed. You got the point? From your side, value should be fixed. Number need not be fixed. From my side, number should be fixed, not value. Your side, value should be fixed, not number. Clear? This keep on repeating in your mind. Your fixed to fixed entire concept is done. Your fixed to fixed entire concept is done. Got it? Chalo. We'll wind up the session here because it is a heavy session. I know that it's a heavy session. You guys revise this and then come for tomorrow's session. Next, we'll continue with compound financial instruments. Okay, we got a lot to cover and it will be theory only because in India is 32, that many sums are not there and only 15 sums are there. That too, they are very, 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 very basic in number. Okay, after that only we need to go for the other sums. You got the point? India is 109. The moment we start, then only we'll be getting big sums and stuff like that. It will be interesting because there only we do all the accounting, recognition and measurement, right? Chalo guys, revise this and come for the next class. All right, Nana. So welcome to the session. Okay, I hope everything is fine. Shall I start now? Okay, so this is where we have stopped in the earlier session, right? So we are done with fixed to fixed test and I gave you the summary at the end, right? So, and I also requested you guys to revise it and come for the next session. And I hope that you guys have revised. So what we'll do now is that we'll go to our solutions material and we'll solve some sums. Unfortunately, when it comes to India is 32, too many sums does not exist. Okay, hardly we have around 15. So this is where we'll stop. And after that, from 16th onwards, again, we have to go to India is 109. All these sums, they belong to financial instruments only. We have nearly 100 pages of problems over here. But still, the thing is, in India is 32, that many are not there. Why? Because your recognition and measurement and all that main stuff goes back to what? India is 109, right? So that is the reason. Anyways, first we'll solve these sums. These are all basic questions only, Nana. First 15 questions. We'll do it. If there is still time, we'll go with some more concepts and we'll try to finish up India is 32 and we'll try to move on to India is 109. Okay. Chalo. First one. A Limited makes sale of goods to customers on credit of 45 days. Okay. You have sold your goods to customers on credit for how many days? 45 days. The customers are entitled to earn a cash discount of 2% per annum if the payment is made before 45 days and an interest of 10% per annum if interest of 10% per annum is charged for any payments made after 45 days, right? Evaluate whether such trade receivable or financial assets or not. Now try to recollect the definition. I hope you remember that. Now trade receivables means, do you have a right to receive cash over here? Do we have right to receive cash? Yes. In that case, is it a financial asset? Yes. Okay. A financial asset is any asset where there is a contractual right to receive cash or any other financial asset from another entity. So obviously, this will be from your memory because you know the definition, right? So you should get it from your memory. Now let's look at the facts of this particular question. Always the proforma is going to be same. First you will write the definition, then you will see the facts of the question, then you will apply, and then finally you'll apply the answer. You'll apply the concept and get the answer. Now, in the above case, A Limited has the contractual right to receive cash and bank from its trade receivables recorded in its books of account after the expiry of credit period, that is 45 days or earlier, provided you give 2% per annum discount. Hence, trade receivables would be what? Financial asset. It may be noted that contractual right to receive cash includes contractual right to receive money in the bank or wallet account. I think this sentence is not necessary. Okay. Now, some of the students don't get it out saying that, so how can we come to a conclusion? How can you even think of this kind of a sentence being part and parcel of the answer? Sometimes ICA gives you unnecessarily a sentence out of nowhere. There will be no justification for the same. He's just trying to say you, he's just trying to tell you that right to receive cash means, cash coming into your bank account also or bank transfers also comes under that. That's what he's trying to say. That anyway we know. Cash or bank balance, we have seen it in the definition itself, right? So therefore, there is no need of this particular sentence over here. Here itself you can write. A financial asset is an asset where there is a contractual right to receive cash or bank balance or another financial asset from another entity. Simple. You write that, it is covered. This sentence is not necessary. I hope this is clear. A simple question, nothing is there. Moving on to question number 2, illustration 2. Now moving on to question 2. Z Limited, the company, makes sale of goods to customers on credit. Okay. Goods are carried in large containers for delivery to the dealer destinations. All dealers are required to deposit a fixed amount of 10,000 as security for the containers. All right. Which is returned only when the contract with company terminates. Now, in these kind of sums, please be careful that he's asking the question from whose perspective. Is he asking you from Z Limited, the company's perspective? In that case, company has to repay the deposits back to the dealers. Or is it from dealer's perspective? If it is from dealer's perspective, it will be a financial asset. If it is from company's perspective, that is Z Limited, it will be a financial liability. Okay. So please be careful and don't hurry up and write the answer. Okay. The deposits carry 8% per annum, which is payable only when the contract terminates, right? If the containers are returned by the dealers in broken condition or any damage caused, then appropriate adjustment shall be made from the deposits at the time of settlement. How would such deposits be treated in the books of the dealers? There goes the clarity. I mean, got it? So, dealer's perspective. So, as a dealer perspective, you have the right to receive the security deposit back because it's your money which you have deposited, right? So, which means you have a contractual right to receive cash. So, which means from dealer's perspective, it is financial asset. Obviously. Are we done? Chalo, let's move on. Illustration 3. Now, when it comes to illustration 3, there is a bit of an issue with your ICA in framing the question itself. So, I'll try to explain you that and we'll try to convince ourselves, and it's a kind of JICA moment all again, you know. Already we have seen it quite a bit of times, but then that's the way it is. Now, A Limited issues a bond at principal amount of CU 1000 per bond. CU means currency unit. Okay, I've written over here so that when you're revising also you'll not have any confusion. Okay, currency unit 1000 per bond. So who has issued? A Limited has issued bonds. Fine. The terms of the bond require annual payments in perpetuity. Perpetuity means still lifelong. Okay, for indefinite life, A Limited has to keep on paying interest. How much? 8%, right? So on this 1000, you need to apply 8% and you keep on paying interest. Assuming that 8% interest to be the market rate of interest. Okay. So according to the question, it assumes that market rate of interest is also 8% for the instrument when it was issued. The issuer assumes a contractual obligation to make stream of future interest payments having a fair value of 1000 on initial recognition. Evaluate the financial instruments in the hands of both the holder and the issuer. Okay. First, you guys read the question. We'll start discussing. Now, I hope you guys are done with your reading. Okay. I'll tell you what is the issue with this particular question. Okay. The first thing that you guys need to understand is, I'll just give you an example to understand the issue in this question. Okay. Only if you understand that, then only we'll be able to get through the answer. Let's say there is a company called PK Limited. Okay. And the risk rating of that company is 12%. Now, you guys need to understand what do you mean by risk rating. Risk rating means generally, if in a particular market, suppose in India, India is kind of a different economy, right? US is kind of a developed economy, ours is a developing economy. So therefore, there the risk appetite will be different. In our country, the risk appetite will be different, all those things. So now, we'll see those things in deep when we go to AFM, okay? Right now, just get the basics, okay? Now, generally, considering the risk of your company or any other company which has got similar risk as your company, then any sane shareholder or any sane, let's put it this way, investor. When I say sane investor, I'm talking about somebody who is informed about all the conditions in a particular, environment, investing environment. Okay, he's informed about everything. He has got knowledge about everything. In that case, any sane investor usually, or any informed investor, let's put it this way, it's a better wording. Any informed investor, any knowledgeable investor would expect at least 12% from your company. That is a point over here. Risk rating is what? 12%, which means for the kind of risk that your company holds, if I have to invest in a company, then I minimum expect 12%. Are you able to are you able to get it? Provided if your company is issuing debentures. Got it? Suppose there is another company. Let's say the risk appetite of that particular company is only 10%, which means that company is far more stronger than this company. In that case, if I have to buy the debentures of that company, if I have to invest the debentures in the debentures of that particular company, then probably I'll be happy with 10%. There is one more company. For that particular company's fundamentals is not that great. It is far more worse than these two companies. Then probably you will be motivated to invest in that company only if, let's say, they pay 16%. You understand the point? So it is like, even though all the companies are giving the same debentures, okay, you will not accept a similar kind of an interest rate because your interest is written for you as an investor, right? It is cost for the company. As an investor, it is written for me. So my return will depend upon my risk. So if all these three companies, suppose they have got same risk, in that case, whichever the company, my return expectation will be same. But all these three companies has got different risk, then my return expectation also will vary. Are you able to get me, right? Okay. So based on an informed investor's point of view, the risk rating of this particular company is 12%, which means generally in the market, anybody who wants to invest in this particular company called PK Limited, they will expect minimum 12% return. That is what you need to understand. Okay. Now, if you give normal debentures, then the risk expectation is 12%, which means you have to pay 12%. Otherwise, people will not subscribe to your debentures, which means people will not be ready to invest in your debentures. Minimum, you have to give them how much? 12%. I'm talking about normal debentures. Now, you can ask me, sir, what do you mean by normal debentures? Normal debentures means redeemable debentures, where I'll be giving you interest every year, and then after 5 years or after 10 years, I'll either redeem it at par or I'll redeem it at a premium. Usually redemption happens either at par or at premium. You got the point? Now, suppose there is something called irredeemable debentures or bonds, just like this particular question. In this, it is perpetuity, means irredeemable. Perpetuity means you will be paying interest every year for this particular bond or debenture for a lifetime, which means there is no end. There is no end means there is no redemption. So we call them as perpetual bonds or perpetual debentures. Got it? Or in other words, you can also call them as irredeemable debentures or bonds. Both has got the same meaning only. Now, perpetual means you keep on paying interest for the lifetime, which means you never redeem, which means irredeemable debentures or irredeemable bonds. Both are nothing but the same. Now, here is the point. When it comes to irredeemable debentures or bonds from the same company, when you compare it with normal debentures or bonds, usually the interest rate will be low. Are you able to understand? Later, we'll discuss this concept in depth. Right now, because this is the third illustration, your ICA has given that way. So you need to, think a bit to understand this particular illustration. Okay. Now you can ask me, sir, why is that when it comes to irredeemable debentures or bonds, the interest rate is less when compared to normal redeemable debentures? Why? Because there is an equity element in this. There is an equity element in this. And because of that equity element also will have a value. So because of that, usually its interest rate will be less. For example, I gave some numbers over here. See here. Suppose you know that this is irredeemable debentures. Means what? This is 0th year till infinity. You'll keep on paying interest. Here in the example, I've just taken some 7 years. Okay. You'll pay interest, let's say 10% only here for irredeemable debentures, right? So if 100 is the value, then you'll pay 10 for the first year, second year, third year, fourth year, fifth year, sixth year, seventh year, 8th, 9th, 10, and so on for indefinite time. You got it? Now, to find out the present value of this particular bond, you should have learned this in your CA Inter or CMA Inter. To find out present value of a bond which is in perpetuity, present value is equal to cash flow divided by discount rate or rate of interest. Okay. So cash flows is 10. That is annuity cash flow, right? What do you mean by annuity cash flow? Every single year, if the cash flow is same, then we call it as annuity. Every single year, if the cash flow is same, we call it as annuity. So annuity cash flow divided by rate of interest or discount rate. Okay. So if you divide that, if you look at the value comes to around only 83.33. You understand the point? Whereas the value of the bond is 100. Whereas if you take the interest and if you discount the interest discounted present value is only 83.33, whereas the value of the bond is 100. So where does the difference go? That difference 16.67 is the value of equity component. Now I can ask me immediately, where the hell does equity component come into picture? Well, the answer is very simple. When it comes to irredeemable debentures or bonds, every single year you have to make interest payment. You got the point? So it is a contractual obligation on your part to pay cash, correct? So therefore it's a financial liability. That part. Which part? The interest payment part. Is that clear? So contractual obligation to pay cash satisfies the definition of financial liability, and therefore this part is financial liability, correct only. But at the same time, in case of redeemable debentures, that is normal debentures, you have an obligation to redeem your debentures, which is nothing but obligation to pay money. So that is also financial liability. In simple words, the entire redeemable debentures or normal debentures is a financial liability, as simple as that. But when it comes to irredeemable debentures or bonds or perpetual debentures or bonds, the interest payment that you pay every single year is a financial liability because it's a contractual obligation on your part to pay cash. However, when it comes to redemption, you don't have any obligation to redeem. You don't have any obligation to redeem when it comes to perpetual debentures or irredeemable debentures. Clear? When you don't have an obligation to redeem, when will you redeem? At your discretion, probably when you wind up your company, when your company goes for liquidation, or at your discretion. When something is at your discretion, at your choice, and it is not an obligation, when something is at your discretion, at your choice, and it is not an obligation, try to remember this word, not an obligation, then it satisfies the definition of equity instrument. Therefore, that redeemable part is an equity instrument. You got the point? Fantastic. So that is the reason, because of that inherent equity instrument inside this irredeemable debentures, you generally pay less interest rate. Are you able to get me? Right, fantastic. Now come here. So therefore, now what is he asking in this question? Evaluate the financial instrument in the hands of both the holder and the issuer. Fantastic. When it comes to holder, you tell me one thing. From the point of view of the holder, what does he have? He has invested in debentures. Fine. He will keep on getting interest for a lifetime, correct? Because it is perpetual. So which means he has got right to receive cash. When it is right to receive cash, you call it as a financial asset. So in the hands of the holder, it is a financial asset. There is no confusion here, pretty simple. Whereas in the hands of the issuer, that is from company's point of view. Now from company's point of view, you have two things over here. One is the interest, which is an obligation to pay cash in future for indefinite time. Therefore, it's a financial liability. However, the redemption option, which is at the choice of this particular company A Limited. You understand the point? It is not an obligation. Provided maybe you will redeem it either at the choice when A Limited decides. Are you able to get me? Or during the liquidation of the company A Limited, probably he has to redeem. In that case, that particular portion will be classified as equity, or it is called as equity instrument. Therefore, from the point of view of the issuer, that is A Limited, the interest will be classified as financial liability. The redemption will be classified as equity instrument. So in one instrument, you have two things, financial liability and equity instrument. So we call this as compound financial instrument from the point of view of A Limited. Now, sir, you did not explain the concept of compound financial instrument, sir. That is the next concept, Nana. We are going, see here. You have the concept, okay? Compound financial instrument, we have examples as well. Then why did you come to the questions straight away? I did not come to the question. Already we have spent so much of time in explaining the concepts now. So therefore, you guys will get monotony. And that is the reason I thought that I'll solve some sums. But the moment we have come to the third sum, we have somewhere a concept of compound financial instrument is imbibed. That's okay. I gave you the basic idea. What is compound financial instrument? In a single instrument, you'll have financial liability as well as equity. That's all. As simple as that. Right? So, based on this example, you should understand that if there is some percentage for irredeemable debentures, generally normal debentures should have more percentage than that. If you look at here, 8% is the percentage of a perpetual debentures. In that case, the market rate of interest, generally we talk it from the point of view of normal debentures only. In that case, definitely it should be greater than 8%. But because there is an assumption that has been given in your question, therefore we just need to we just need to follow what ICA says. But usually it should be more than 8%. It should be more than 8%. Either the question is wrong or answer is wrong. It's a JICA kind of a moment. But that's okay. Because when I say market rate of interest, generally that will be there for normal debentures. So therefore, it has to be greater than 8%. Because when there is irredeemable debentures at a particular interest rate, then definitely the market rate of interest, which will normally be told for redeemable debentures, it should be greater than 8%. Some 10% or 12% it should be. But that is not the case in this question. That's why this question is a little bit, okay, we have to convince ourselves. In exam also, we need to write the same answer. That's the way it works. So there is a little bit of issue in the question. I hope this is clear. Okay. You got it? Any doubts with respect to this one? All right, fantastic. Chalo. That compound financial instrument concept which I've explained you, if you have understood 50% also, it's okay, Nana, because anyway, we're gonna see it. That's the reason I've shown you the proof also. Otherwise, you guys will have doubt and then you will keep asking me, okay? Clear? Right, moving on to next one, illustration 4. Because since last few sessions, I think like 4 sessions, we have been going through concepts only, okay? Because there are no much sums, because I told you at the beginning itself, India's 32 is all about definitions and theory, right? So therefore, you'll get that monotony, right? So therefore, I thought that, okay, we'll solve few questions. Anyway, only few questions are there when it comes to this particular India's 32, and then we'll go to India's 109. Got it? Of course, still there are some concepts left in 32. That also we'll do. Now, illustration 4. You guys are ready? Chalo. Creditors for sale of goods. Okay. A Limited, the company, makes purchase of steel for its consumption in normal course of business. Okay. The purchase terms provide for payment for goods at 30 days credit and interest payable of 12% per annum for any delays beyond the credit period. Okay, you purchase steel for consumption, you have to pay to the creditor. Fine. Analyze whether the transaction leads to any financial instrument, and if yes, then what is the nature of the financial instrument? Very easy. You have a contractual obligation to pay cash, therefore it's a financial liability. So first write the definition of financial liability. A financial liability is any liability where there is a contractual obligation to deliver cash or any other financial asset. Done. In the above case, because A Limited entered into contractual agreement for purchase of goods, they have a contractual obligation to pay cash to the creditor. Done. Chalo, easy peasy. Moving on to illustration 5. Come to illustration 5, guys. Illustration 5. Now moving on to question number 5. A Limited, the company, makes a borrowing for Indian rupees 10 lakhs from RBC Bank, okay, with bullet repayment of 10 lakhs and an annual interest rate of 12% per annum. So till here it is quite a bit normal. Now, company defaults at the end of 5th year, and consequently a rescheduling of the payment schedule is made beginning 6th year onwards. Fine. The company is required to pay I think 1 million, it's in million. I think they did not change it. Actually, it is 13 lakhs. Okay. At the end of 6th year for one-time settlement. Instead, in lieu means instead. Okay. So, in lieu of defaults in payments made earlier. All right. Does the above instrument meet definition of financial liability? Please explain. Analyze the differential amount to be exchanged for one-time settlement. Okay. Now, you tell me how much. What is the principal amount that you have to repay? 10 lakhs. Okay, let me do the calculation over here. 10 lakhs is the principal amount that you have to repay, right? So, amount payable at the end of 6th year. How much you gonna pay? 13 lakhs, right? Okay. At the end of 6th year, actually, you have to pay 13 lakhs. So, did you default on 5th year, right? So, logically speaking, you have to actually pay 10 lakhs only, because you defaulted on 5th year and ultimately you're paying on 6th year. So 5th and 6th year you have to pay interest, logically speaking, correct? So which means if the bank is fair, how much they have to charge from A Limited? You have 10 lakhs, which actually you have to pay, okay, into how much is the interest you are paying? 12% into 1.12. This is the interest for 5th year, okay. Why did I multiply with 1.12? Because once you multiply that, you get principal with interest. Okay, directly we'll get the figure. Into again 1.12. This is the interest for which year? 6th year. Because 5th year he has to pay. He did not pay in 5th year. So 5th year interest will add upon. Plus 6th year interest will add upon. So if you do this calculation, how much is the number that you're getting? Help me out with the number, guys. 12,54,400. So logically speaking, the bank should ask you only 12,54,400. Are you able to understand? But they are asking how much? 13 lakhs. So which means, based on the question, are there any differential amount to be exchanged for one-time settlement? Yes, because bank is asking for 13 lakhs, which means there is a difference amount of 45,600, correct? Now, what is this 45,600 is for? because of the default mistake that you have done, that is A Limited has done. A Limited is being fined by the bank. So you are getting fined eventually. So I have to pay that much extra. So is it a favorable condition or unfavorable condition for A Limited? It is unfavorable. Now try to recollect the definition of financial liability. There was one point which specifically I've told you. It's a kind of an arrangement, okay, a contractual obligation where you have to pay cash against a settlement of a financial liability under conditions that are unfavorable to your company, that is A Limited in this case. This is also part and parcel of the definition of financial liability, where you pay something extra because of the situations unfavorable to you. If it is favorable, then that's a different thing. It goes under financial asset. If it is unfavorable, then it comes under financial liability. So therefore, first of all, it's a financial liability. There is no doubt in that because there's a contractual obligation on your part to pay cash. That everybody knows. It's a kid's answer, right? What is important for us is to answer the B part of the question. A part everybody knows. So that's why I didn't even discuss that. Okay. Coming on to B part, once you have done this calculation, you know that this guy has defaulted for 2 years. Fifth year he has to pay. He did not pay fifth year. So fifth year interest will be added upon. Sixth year interest will be added upon. And after sixth year he has paid eventually. So 2 years interest should be added. Ideally he should be paying only 12,54,400. Anything that he pays up and above 12,54,400 is a kind of a situation where this is a contractual obligation to pay cash to the extent of 13 lakhs, where that extra 45,600 is unfavorable to your company. So when something is unfavorable to you, obviously it falls under financial liability definition as well. That is what you will be writing. Okay. Later you can go through this answer, and this paragraph is the important part of this question. Next time when you revise also, when I say this is important, I've already marked it. It is there in your solution book, right? Even if you take printed also. So this is what you will revise. Rest of the things are normal. Got it? Are we done with this? Shall we move to the next one? Yeah. Okay. Any doubts, Nana? With respect to this question, any doubts? Illustration 5. Okay. Shall I move to the next one? Fantastic. Now come to illustration 6. Silver Limited issued irredeemable preference shares. Irredeemable. Ignore this for the moment, what I've written. Later you will understand. But some of you, if you're smart enough, you would have understood by now. Irredeemable preference shares with a face value of 10 each and premium of 90. Okay. These shares carry dividend at 8% per annum, right? However, dividend is paid only when Silver Limited declares dividend on equity shares. Fantastic. So, which means it is discretionary. It is not obligatory. It is not compulsory. It is not mandatory. Okay. Analyze the nature of this particular instrument. Simple, Nana. First of all, preference shares. All right. You are paying dividend, right? When are you paying dividend? Is it compulsory? Whether you have sufficient profit or not, you have to for sure pay dividend. Is it mandatory dividend kind of a situation? No. Discretionary dividend. Okay. Then because it's preference shares, initially you get money, tomorrow you have to redeem it. Now, is it compulsorily redeemable preference shares? Well, the answer is no again. It is irredeemable preference shares. So, let's apply the concept. What is the concept? Substance over form. What is the form here? The form is, it is in the form of preference shares. But according to Ind AS 32, you have to look into the substance rather than the form. The form is preference shares, but let's look into the substance. What is the substance? Both dividend as well as the redemption, both are not obligatory, in the sense they are not compulsory. There is no obligation. When there is no obligation, definitely it satisfies the definition of what? Equity instrument. Therefore, analyze the nature of the instrument. What is this instrument? Equity instrument. You got the point? Suppose if there is mandatory dividend, let's put it this way. If there is mandatory dividend, which means you have to pay preference dividend irrespective of your profits, then that becomes financial liability. And if it is irredeemable, then there it is at your discretion. Which is at your discretion? Redemption. Then it becomes a compound financial instrument. Are you able to get me? Suppose both are mandatory. You have to pay dividend mandatorily. Even your redemption is also mandatory after 5 years. In that case, it's a financial liability because both are financial liability only, where you have a contractual obligation to pay cash. So like this, you just keep on thinking so that things will become easy for you. Are you able to get me? Everybody? Done? Okay. You can just go through this later. Whatever I've explained you, that is what it's there here. Chalo, come to illustration 7. Illustration 7, Nana. Ready? Okay. A Limited invest in compulsorily convertible preference shares. Fantastic. Look at the wording, compulsorily. So convertible preference shares, which means it has to be converted into equity shares for sure. Okay, right. Then what? Issued by its subsidiary. Okay. B Limited at 1000 each. 10 is the face value, 990 is the premium. Fantastic. Under the terms of the instrument, each compulsory convertible preference shares, which is nothing but CCPS, is compulsorily convertible into one equity share of B Limited. Okay, it is 1:1, so it's easy. All right. Next, at the end of 5 years, okay. Such CCPS carry dividend at 12% per annum, okay, payable only when declared at the discretion. We have our wording, discretion. Discretion means what? At your choice. When I say at your choice, whose choice? Company's choice. Correct? At your choice, company's choice. In that case, is there any obligation? No obligation. Okay, at discretion of B Limited. Evaluate this under the definition of the financial instrument. Now, you people tell me, first of all, did we complete fixed to fixed test? Yes. Let's apply it. Now tell me, is it getting converted into fixed number of equity shares? As you can see, every one preference share will be converted into one equity share. Correct? Yes. Okay, fantastic. So which means, does it satisfy the fixed to fixed test? Yeah, here, yes. Next, when it comes to dividend, is it mandatory or at discretion? It is not mandatory, it is at the discretion, which means, is there any obligation? No obligation. Now, so there is no obligation when it comes to dividend, automatically it satisfies equity instrument definition. Also, the conversion is with respect to fixed number of equity shares. Here also fixed to fixed test is getting satisfied. So looking into both the points, what kind of an instrument it is? Equity instrument. I told you when it comes to equity instruments, we have seen two concepts now. One is where the company settles its own equity instruments, and the other part is where somebody gives company its equity instruments. You understand the point? We have seen only one part. In that also we have seen only fixed to fixed test. After that, we have to see contingent settlement provisions. We also need to see compound financial instruments. And then we have to go to the right side. Right side, we have buyback and all that stuff. You guys remember that? So out of this 6, totally I've given you 6. Where one part is where company settles in its own equity instruments. The other part is where somebody gives company's own equity instrument to the company. You understand the point? So in both these parts, we have covered only one theory portion, that is fixed to fixed test. That's all. The rest of the things we did not cover. We'll cover it. Don't worry. So are you able to get me? So now coming on to this particular question, with respect to dividend, there is no obligation. So it is at its discretion. Therefore, it satisfies the definition of the equity instrument. Also, when it comes to the conversion nature, it is getting converted into fixed number of equity shares. Therefore, this will be classified as equity instrument. So you have written both the conditions over here. And according to the definition of equity, there is no contractual obligation to deliver cash or any other financial asset. Dividends are also discretionary. Are you able to understand? Therefore, there is no contractual obligation. Conversion into fixed number of equity shares satisfies the fixed to fixed test. Hence, it meets definition of equity instrument and shall be classified in such books of B Limited. You got the point? Hello? Initially the amount they have received is also fixed amount only, na? Got it? There is also no variation. Yes? Is that clear? Chalo, done. Illustration 7 is done. Moving on to illustration 8. Come to 8th question, Anna. Illustration 8. Okay. Target Limited took a borrowing from Z Limited for 10 lakhs. Okay. Z Limited enters into an arrangement with Target Limited for settlement of the loan against issue of a certain number of equity shares of Target Limited whose value equals 10 lakhs. Whose value equals 10 lakhs. For this purpose, fair value per share to determine the total number of equity shares to be issued shall be determined based on the market price of the shares of Target Limited at a future date upon settlement of the contract. Evaluate this under definition of financial instrument. Very simple. Okay. Initially, you received fixed amount from the other party. So therefore, you received Y rupees. That fixed to fixed condition is satisfied. One side of the coin. Other side of the coin is from our side. From our side, is the number of shares is fixed? No. You will give that many shares which will be equal to the 10 lakhs value. So it depends upon the market price on the future date. You understand the point? On that date, how much will be the market price per share, you will divide it with 10 lakhs. Accordingly, those many number of shares will be given. Now tell me, is this number of shares in this kind of situation over here? Exactly this example I gave you. This is nothing new. Already we have discussed this example. We have gone through so many cases now. In that one of the cases, this only now. Exactly the number is also 10 lakhs if I'm not wrong. Now you people tell me, is the shares or fixed here, number of shares, or it is variable in nature? It is variable in nature. Therefore, did it satisfy fixed to fixed test? Yes, one half is satisfied, where from the other part, y amount of rupees is given, where the amount is fixed. But from my part, x number of shares are not given, because the shares are not fixed. It can be variable, obviously, depending upon the market price on the future date. Therefore, fixed to fixed test is not satisfied. And obviously, it is not satisfied. You cannot classify this as an equity instrument. Obviously, it will become financial liability in that case. Correct? Now see here. In the above scenario, Target Limited is under an obligation to issue variable number of equity shares equal to the total consideration of 10 lakhs. Hence, equity shares are used as a currency for purpose of settlement of the amount payable to Target Limited. Payable by Target Limited. Since this is variable number of shares to be issued in a non-derivative contract for fixed amount of cash, it tantamounts to use of equity shares as currency, and hence this contract meets the definition of financial liability. It's very easy, Nana. Once it is not an equity instrument, automatically it will be financial liability. Only two choice only. Okay, financial asset is in a different world. Always the confusion will be between whether it's a financial liability or it's an equity instrument. You apply the fixed to fixed test, satisfied, equity instrument. Not satisfied, automatically financial liability. Simple. Even if you observe these wordings also, what is the wordings? Use of equity shares as a currency. This word also I've used when I was teaching you the concept. You just revise through the concept. If you have revised it, you will remember it pretty easily. Are we done with this? Okay, easy question only, because already we have seen this as an example. I don't know which case we have seen, but we have already seen that. Okay, coming on to additional questions. Question number 1. So I think till here we can see. Okay, till question number 15. From question number 16, it is Ind AS 109. Right, let's go with the additional question. So already we have done with 8 plus another additional questions will be 15. So somewhere around 23 we'll be doing before we go to other concepts. Okay, right, let's come to question number 1 in additional questions. You guys are ready? Now moving on with the first one. Nana, this is heading. This will not be there in the examination. Okay, it will be helpful for you while you are revising. Okay, your question starts from here. Let's have a look at it. A Limited issuer. Okay, A Limited is the issuer. Issues preference shares to B Limited. B Limited is the holder. Okay, those preference shares are redeemable at the end of 10 years from the date of issue. Fine. And entitle the holder to a cumulative dividend of 15% per annum. Okay, cumulative. Right. The rate of dividend is commensurate with the credit risk profile of the issuer. Okay, in the sense it is same. According to the credit risk, how much should be the rate of dividend? That much it is. Examine the nature of financial instrument. All right. Now, here your IC answer is not actually correct. Why? Because the moment you see the word cumulative dividend, what do you mean by cumulative dividend? Sometimes you pay dividend, sometimes you don't pay dividend. Even when you don't pay also, it accumulates and then it gets accumulated, and then eventually one particular day you have to pay. Are you able to understand? So generally there are two perceptions. Okay, I'm not saying your ICA is wrong here, but I'm just trying to give you an alternative perspective. Okay, how internationally this has been viewed. In some books, especially when I've gone through this IFRS and stuff, they take cumulative dividend as a discretionary dividend. Why? Because they are of the opinion that when will you use a word called cumulative? When you don't have an obligation to pay dividend every single year. So it is not mandatory you have to pay every single year. When you have low profits, you don't pay. When you have higher profits, then you put together that particular year's dividend also, and then you accordingly pay. That's what you mean by the word cumulative, correct? For example, let's say 3 years, Nana. First year the profit is not good. You have to pay 1000 rupees. You will not pay 1000 dividend because there is no profit. Second year also there is no profit, so you are not paying 1000. This gets cumulative. This gets cumulated in the sense now still 2000 you have to pay. Third year you have fantastic profits. Third year also you have to pay 1000 plus last 2 years you did not pay because you did not have good profits. Last 2 years 2000, total 3000 put together. You understand the point? You will pay dividend. This is what we call it as cumulative dividend. So this can be seen from two perspectives. There are two sides of the coin over here. The first side of the coin, people are of the opinion that Since you did not pay first year and second year, the dividend payment is at your discretion, because when you get good profits, then only you will pay. On that logic, it can be said that this is a discretionary dividend. The other side of the coin is, okay, you're not paying, but then at the end of the day, one day you have to pay everything, right? So it's as if you're paid every single year. You understand the point? See, first year 1000 you have to pay, second year 1000 you have to pay, third year 1000 you have to pay. So because of not having sufficient profits, first 2 years you did not pay, but at the end of the day, third year you are paying 3000 now. Suppose you pay only 2000 at the end of third year, then I can say that it is a discretionary dividend. But third year you are not paying 1000, you are paying for first year, second year and third year put together in third year. So therefore the other side of the logic is that I will see this as a mandatory dividend only, because you can't escape from paying dividend now. This is other side of the logic. I hope you are able to get me. Now you can ask me, sir, why are you saying both the perspectives, sir? Why am I saying this? Because as far as this question is concerned, your ICA went with the second perspective, where even though you don't have an obligation to pay preference dividend every single year, but at the end of the day, because it is cumulative, one particular year you have to pay for all the years that you missed. Therefore, I will consider this as a mandatory dividend. But in few other questions where I've seen in your ICA material itself, okay, they have gone with the first perception as well. So therefore it becomes duty for me to inform you both the perspectives, so that when you come across another question where the situation is same, but then your ICA went with exactly opposite answer, there you should not get confused and then ask me, sir, what is this? You understand the point? Clear. Now, internationally they say they go with discretionary, but when it comes to ICA, they went with mandatory concept. Okay, they consider this dividend as mandatory. So when it is mandatory and anyway you have to redeem it, so dividend is mandatory, so there is a contractual obligation to pay cash every single year. Every single year, in the sense, even though you miss few years, put together you have to pay anyway. You can't escape from it, right? From that perspective, it is mandatory. Okay, and there is a contractual obligation to redeem also, right? In that case, obviously, it will be classified as financial liability. I hope this is clear. Got it? I hope I explained you both the perspectives. Why ICA went with the second perspective, that is their choice, none at the end of the day. Because sometimes what happens is that your ICA picks answers from a particular author's book. Okay. It depends upon what is the perception of that particular author. They'll take that particular answer and then they go with it. You got it? That's the way it is. Now, are we done with question number 1? Question number 2. X Company Limited issuer issues debentures to Y Company Limited holder. Those debentures are redeemable at the end of 10 years. The moment it is redeemable, obviously it has to be a financial liability. Which one? That redemption part. From the date of the issue. Interest of 15% per annum is payable at the discretion of the issuer. Okay, redeemable is a financial liability, but discretion is not a financial liability. Discretion means it becomes equity. Let us look at the other sentence. The rate of interest is commensurate with the credit risk of the profile of the issuer, which means whatever the market profile risk is there, exactly your risk is, your return is on par with your risk. So there is no problem. Examine the nature of the financial instrument. Redeemable, financial liability. Discretion, this is equity. In that case, this becomes compound financial instrument. Got it? So mandatory redemption, financial liability. Interest payable at the discretion of the issuer, equity. So obviously it has to be a compound financial instrument. What did this guy do? The first component is a contractual obligation to deliver cash, okay, to the debenture holder that cannot be avoided. So obviously this will be financial liability. This component of the instrument is financial liability. Okay, what about the other component of the instrument? That you need to explain now. Look at the IC answer. One component is financial liability, Nana. Correct only, that we also know. He has explained that part and said that it is a financial liability, which means he has explained only the redemption part. And then he has stopped the answer there itself. Okay, what about the interest part? There you don't have any mandatory cash payment, so that becomes equity. Totally the instrument becomes compound financial instrument. This is the problem with your ICA. Okay, this is again JICA scenario. All right, are we done with this? Answer is incomplete actually. He has answered only one part, that is redemption part, which is a financial liability, that's for sure. But interest part he did not answer. That's okay. Let's move on to the next one. Are we done with this? Anyway, I have written the answer over here. I hope you guys can proceed with that. Moving on to question number 3. Question number 3, guys. Now, D Limited issues preference shares to G Limited. The holder has an option to convert these preference shares to equity instruments. Okay, holder has the option. Very, very, very important. Not the issuer. D Limited issues preference shares means Delimited is the issuer. Does delimited has got the option? No. Holder has the option. Who is the holder? G Limited. G Limited has got the option to convert these preference shares into equity instruments of the issuer anytime up to a period of 10 years. Okay. If the option is not exercised by the holder, that is G Limited, the preference shares are redeemed at the end of 10 years. Examine the nature of the financial instrument. This is where I gave you an important sentence saying this is the PKSIR's hack. This entire standard is not about what usually happens, what most likely happens. It is about what can happen, right? Now, examine the nature of the financial instrument means first thing from whose perspective you have to examine. We started with delimited, right? So therefore, we need to analyze this from delimited's perspective. Now, from delimited's perspective, you tell me one thing. I gave preference shares. Okay. Now, did he talk about the preference dividend over here? Nowhere he has talked about preference dividend. So we don't know about that. Question is silent. He has talked only about the conversion part. So either you can redeem your preference shares after 10 years or you can convert it into equity shares. Now the question is whether you will redeem or you can convert these preference shares into equity shares is not in your hands. Is not in the hands of delimited. We are seeing it from delimited's perspective. So it is not in the hands of the delimited. It is in the hands of what? G Limited. Now tell me from delimited's perspective, if I am delimited, do I know what G Limited will do in future? G Limited may exercise the option of conversion or G Limited may keep quiet. So if G Limited exercise the option of conversion, then the instrument becomes equity. If G Limited does not exercise the option of conversion, then I have to redeem it for sure. Then it becomes a financial liability for me. Now you people tell me when both the options are possible, which is at the hands of the holder and issuer, that is D Limited, has got no control whatsoever, then how can I classify? It depends upon that guy. If he exercise the option of conversion, for me it's an equity instrument. If he does not exercise the option of conversion, for me I have to redeem the preferences, then it becomes a financial liability for me. You understand the point? Now tell me, apply the hack, PKSIR's hack, which I've told you. What is the hack? It is not about what usually happens. It is not about what most likely happens. It is about what can happen. What can happen means there is a chance of redemption. What can happen? Redemption can happen. In that case, classify that as a financial liability. That's all. Now see here, the instrument has two components: contractual obligation, that is conditional on the holder exercising its right to redeem, or conversion option with the holder. The first component is a financial liability because the entity does not have unconditional right to avoid delivering cash. In other words, can D Limited avoid delivering cash? No. If G Limited exercise the option of, does not exercise the option of conversion, then D Limited has to redeem. When I have to redeem, I have to pay cash. So can I avoid? No, no, no. If G Limited wants, G Limited can avoid. The other guy can avoid. I cannot avoid. You understand the point? The answer is from the perspective of delimited. Therefore, from delimited point of view, can I avoid? No, I can't. If the other guy says that I don't exercise the option of conversion into equity shares, you just try to redeem it, then I have to redeem it. I don't have a choice. So therefore, I delimited, D for Delhi, delimited has got no option. I cannot avoid payment of cash. If G Limited asks me to redeem the preferences, I have to pay cash. Therefore, I can't avoid it. When I can't avoid it, I have a financial liability. Simple. In the section compound financial instruments, we will also analyze the other component, the conversion option with the holder, and we will explain the nature of instrument from its entirety, which means from the perspective of the holder as well. Okay. Overall, it's a CFI due to lower rate of interest. That we will see later. Already I gave you a brief idea of what is this in illustration 3. Okay, let's not complicate this right now. Once we do the concept of compound financial instrument, you'll get 100% clarity. Right now, you know this. We have seen this slightly in illustration 3. So it's not something that is totally new for you. Okay. Now let's move on to question number 4. We have solved this from whose perspective? Delimited's point of view. Let me write here. Answer is from delimited's point of view. Some students will get confused here also. They'll be thinking from G Limited's point of view and then they'll say that the answer is not correct. Don't do that. Okay, answer is from D Limited's point of view. All right. Got it, Nana? Chalo, fantastic. Come to question number 4. Question number 4. All right. Now, yes, Nana. Still, we did not cover compound financial instrument, Nana. That's why. Okay. We'll see that once we cover. Already you do have an idea because illustration 3 we have solved. Na? Okay. Right. Clear? Okay. Let's move on to the next one. On 1st January 2001, it can be 2011 also. Let's take it as 2001. X can be anything, or it can be 2021 also. Okay. Entity X writes a put option. Now, first, the moment you see this, first try to understand what does this sentence mean. Entity X writes a put option means, first of all, put option means right to sell. Right to sell is for whom? The one who buys the put option. Here, this guy has written the put option means he is the seller. Seller will always have an obligation. When buyer has got right to sell, then the seller has got obligation to buy. Correct? Yeah? So entity X writes put option means immediately you need to translate that. So what is the translation? Obligation to buy. Provided if the other guy, the option buyer, exercises the option, then only he'll have obligation to buy. Okay. So entity X has written a put option over 1 lakh of its own equity shares. So it has got obligation to buy own equity shares. Obligation to buy own equity shares. Fine. For which it receives a premium of 5 lakhs. Okay. Why receiving a premium of 5 lakhs? Because you're an option seller. So when you're option seller, you will receive a premium money. If you're option buyer, you will pay the premium money. We have seen all these concepts, right? Under the terms of the option, entity X may be obliged to take delivery of 1 lakh. Why the word may be is used? May be obligated to take delivery of 1 lakh of its own shares. Why? Because the other guy, he has got right to sell. He does not have obligation to sell. So when there is a word right to sell, the option buyer, if he is beneficial, he will exercise the option to right to sell. In that case, it becomes obligation for me. If he does not exercise, then I need not buy. You understand the point? That is the reason the word may be is used. Because he may or he may not be obligated to buy. Clear? Huh? It depends upon the other party. If other party exercises the option, then entity X is obligated to buy its own equity shares. If the other party does not exercise the option, then I'm not obligated. So that is the reason the word maybe is used. Every word in the question does make sense. Please try to understand. Okay, entity X may be obligated to take delivery of 1 lakh of its own shares in 1 year's time and to pay the option exercise price of 22 million in this case. 22 3 zeros and 3 zeros. So 22 million or 2 crore 20 lakhs. Okay. The option can only be settled through physical delivery of the shares. Okay. Examine the nature of the financial instrument. First of all, is it a derivative? It is a derivative. The moment I talk about option, it's a derivative, right? Obviously, it's a derivative. Forward contract, future contract, options, okay, interest rate swaps. We have seen all these things now. Okay, at least we have seen the names. I gave you examples as names. We have covered only the concepts of forward contract, future contract, and options. That's all. This question is within the concepts that we have covered. So now tell me, is it a derivative first of all? First of all, it's a derivative. Then we will decide whether it's a financial asset or it's a financial liability or it's an equity instrument. If it is a financial asset, then it will be referred as DFA. DFA means what? Derivative financial asset. If it is financial liability, then it will be DFL. DFL means what? Derivative financial liability. If it is an equity instrument, then we'll say DEI. It's a derivative equity instrument. You understand the point? First of all, it's a derivative. Whether it's a financial asset or financial liability or equity instrument, we'll see later. Let's see. Okay. Is that clear till here? Okay. Now tell me, this derivative involves entity X taking delivery of fixed number of equity shares for a fixed amount of cash. Correct? Just a second, Nana. Just a second. All right, Nana. Now, let's continue with our discussion. Now, you need to understand one thing first. It is a derivative. That one thing is for sure. Now, from your perspective, now many of the students, the moment after I'm done with the first sentence, you'll be coming with a conclusion that let's classify this as a equity instrument. Why? Because it has satisfied fixed to fixed test. You need to understand one thing. Entity X taking delivery of fixed number of equity shares, is it 100% probable to happen? taking delivery of fixed number of equity shares means what? Whatever the 1 lakh commitment that they have made, this is not a future contract where 100% it will happen. This is an option. So where entity X has to pay this much money and take the fixed number of equity shares where the money is fixed, the number of shares is also fixed. It is satisfying fixed to fixed test only. But the point is it 100% sure? No. It can happen or it may not happen. That is the first point you guys need to understand. Okay. Right. The second thing is, so therefore there is always a question mark. Correct? There is always a question mark. Right. Suppose this guy does not exercise, then what will happen? You understand what I'm trying to say? Okay. Now, so 22 million is conditional on the holder of the option exercising the option. So only if the holder exercises the option, then only you have to pay 22 million and get 1 lakh of your equity shares. Otherwise, this will not happen. Fantastic. So now, entity X has an obligation to deliver cash, which it cannot avoid. Correct? From my perspective, from entity X perspective, I have already received the premium. Tomorrow, if the holder of the option exercises the right to sell, then I'll have an obligation to buy. When I have an obligation to buy, I have to pay cash. If I have to pay cash, then obviously what is the situation that is happening? I have a contractual obligation to pay cash. What can happen? Again, recollect the word that I've told you. It's not about what usually happens. It's about what can happen. Is there a chance of you as a company paying 22 million and then getting 1 lakh shares? You understand the point? 1 lakh shares only, huh? Yeah. Is there a chance of that happening? Yes, it will happen, provided if the other guy exercises the option. When the other guy will exercise the option, when he believes that this contract is beneficial to him, then he'll exercise the right to sell. Then we have an obligation to buy by paying cash. When you have an obligation to buy by paying cash, it is a financial liability. It is a financial liability. It is a financial liability. Clear? Now, so what is the accounting treatment? Right now, we did not discuss about accounting treatment. Later, we'll see. But in this question, there is a portion of that as well. So therefore, 50% you will understand, 50% you will not understand. So adjust with me, okay? So what you will do is that, tell me one thing. The other guy has got right to sell, correct? The holder of the option. He will have right to sell what? He will have right to sell your own equity shares only. So where is your own equity shares in your balance sheet? It is there in equity only, na? What do you mean by equity, Nana? In your equity, whoever has purchased your equity shares will be there, correct? Now, this guy you entered into an agreement where you have written the put option where the other guy has got right to sell your shares only. Got it? So where you have to buy your shares only. You understand the point? If he does not exercise the obligation, if he does not exercise the right of the put option or right to sell, then what will happen? You will not buy your own equity shares. When you don't buy your own equity shares, where will your equity shares be? It will be in equity only. You understand the point? You got it? So right now, just try to understand. Okay, I entered into an option contract where I have an obligation to buy my own equity shares, provided if the other guy exercises the option. Till the time he exercises the option, where is my equity shares? It is there in the market only. Nah, I'm not buying it. So if it is there in the market, means it will be in my equity in my balance sheet. Right, clear? So right now my equity shares are in the equity column of my balance sheet. Correct? It is under the name equity. Now, because I have entered into an agreement, I have entered into a derivative contract where I may have to pay cash and buy my own equity shares. Therefore, there is a contractual obligation for me to pay cash. That can happen. So I cannot unconditionally avoid paying cash. I cannot unconditionally avoid paying cash, because when the other guy, the option holder, exercises his right to sell, I have to compulsorily pay cash. So can I avoid paying cash? I can't. In that case, it becomes a financial liability. Therefore, I have to reclassify from the equity column to financial liability. That is what the first sentence is. Where is it? Yeah, reclassified from equity. Reclassified from equity to financial liability means what? That amount will be under the equity column. You need to take it out. Taking it out means equity has to be reduced. How will you reduce the equity? Equity is showing credit balance. Now, equity is a liability. So obviously, it's not a liability. It will be showing credit balance. Okay. So therefore, you have to debit it to reduce it, and then you will credit the financial liability. So the entry will be equity to financial liability. The entry will be equity. Array here. Equity debit. So equity will be reduced to financial liability. So financial liability is getting created. It will be like this only. Okay. After that, what you will do some accounting treatment and all. I don't want to go through all these paragraphs because you'll get confused. You will know this only when we go to Ind AS 109. As of now, we did not cover Ind AS 109. We'll be applying ACM method. There are so many methods. ACM method, FETPL, FETOCI. Under ACM method, what you will do, you'll find out the present value and then you'll recognize the interest. You'll add the interest. Eventually, you'll take it forward and then eventually you'll try to account it. That if I say, you'll get confused. So let's not get into the accounting part. Clear? Let's not get into the accounting part. Okay. We will skip this for good. Once we are done with, once we enter into Ind AS 109, automatically you'll understand these are all very basic things. Okay. So let's skip that part because we did not cover. Now, so initially this much you have understood. So right now your own equity shares are in the hands of somebody else. Tomorrow you might have to buy it. You have an obligation to buy. So therefore it is under equity column. Now this arrangement becomes a financial liability. Therefore to that extent you reduce it from the equity column by debiting the equity obviously. Debiting the equity is nothing but reducing from equity. 2, you create a new financial liability. Financial liability is a credit balance obviously. So 2 financial liability you will do. So the entry will be equity to financial liability. Clear? Now tomorrow suppose he exercises the option. He exercises the option. Then what you will do? You will be paying cash. So to cash or bank. And financial liability will be gone. Because once you pay the cash, your financial liability is gone. Therefore, you will be debiting your financial liability. So tomorrow, financial liability to cash will be your entry, provided if he exercises the option. So he exercises his option of right to sell. Then you have an obligation to buy. So because you have an obligation to buy, you pay cash and your financial liability will be debited. So it is gone. Once you pay cash, there is no more liability. So therefore, liability will be debited and it is gone. Clear? Suppose if he does not exercise the option tomorrow, if he does not exercise the option is lapsed by the option holder, then what I'll do? I no more have any financial liability because he has lapsed the option. So I don't have any obligation to pay cash to buy those equity shares by paying cash. Correct? Therefore, what will I do? I no more need financial liability. So financial liability will be debited. But instead of writing to cash or to bank, because I don't have an obligation to pay cash or bank, I will write to equity again. So exactly opposite entry will be there. Financial liability to equity. Again, it will go under equity only. You understand the point? So again, I repeat, initially your shares are under equity column. Now, because you have created a financial liability because of entering into selling your put option or writing your put option, you have created a financial liability. Therefore, reduce it from the equity and create a financial liability. Therefore, equity to financial liability. Tomorrow, if he exercises the option, then you have to pay cash. Therefore, to cash or bank, and your financial liability has to be eliminated because you are paying cash now. Therefore, liability is gone. Therefore, financial liability to cash or bank. If he does not exercise the option, then whatever the entry that you have created right now, you just put the opposite entry. So what is your entry right now? Equity to financial liability. You have created financial liability. Once he lapses the option, there is no more financial liability for you. So debit financial liability and again create equity, because from equity only now you have put it into financial liability. Now again you do the reverse. So financial liability to equity. That's it. If the other guy lapses the option, that's your answer. Clear? In between whatever these two paragraphs he has told you, this will come under Ind AS 109, that ACM method and all that stuff. Right now you don't understand, so therefore you can ignore it. Whatever the extent, to that extent, whatever I've explained you right now, that much is enough. Clear? Is it clear? Right, sure. Okay, so we will wind up the session here. I think we have solved 13 sums in this particular session. 13, sorry, 12 sums. Okay. Now in the next session, we'll get back and then we'll cover remaining concepts. I think still we have few concepts to go, compound financial instruments and all that. Let's cover that and then we'll come back and then we'll solve rest of the sums. We have 11 more sums to go. After that, we'll go to Ind AS 109. Okay, chalo. We'll wind up the session here. These many problems are enough. Now, I hopefully that monotony should be gone. In next session, we'll go with compound financial instruments and other concepts. Because if you can see, where is it? Here. Only fixed to fixed test is covered so far. We have to cover compound financial instruments, then contingent settlement provisions. Then we have to come to this side where entity receives its own equity. Here only you'll have writing put option on own equity. This is what we have seen in the question right now. You understand the point? Because questions are not in order the way we are covering the concepts. Okay. So we did not cover this concept. before that only, I have explained you the question which we have solved right now. That is the reason some of you might have felt a little bit. That's why I took a lot of time to explain. I hope you guys have understood. Okay, so we have not yet covered that particular concept. We will cover it in future. Okay, that's the reason I've stopped the sums with this particular sum. Clear? Are you able to get me? So we will cover this in future, which means what you need to understand is right now we have solved a problem without covering the concept actually. But still, I hope I have explained you well. I've explained you clearly. I hope you have understood the concept. Okay, right? Now, even though if you don't understand also, that's okay. You can ask me the doubt. You have the number over here, WhatsApp, and ask me the doubt. Those who are watching the video lectures in future, right now who are in live, do you have any doubt, Nana? No, sir. No, sir. Okay. Anybody? Okay, chalo. So only this concept is done. Rest of the things we'll cover up. I mean, we'll cover in the next session. Okay, from here. At least, except for the last sum, for which the concept we did not cover yet. Rest of the sums, I hope you found it easy. Okay, to understand and to work it out. Except that JICA moments, rest of the things should have been easy for you. Is it easy? Right. Chalo. Okay, let's wind up the session over here. In the next session, we'll continue with the rest of the concepts and then we'll go back and finish off those balance 11 sums I think we have got. Okay, we'll finish that off and after that, we'll go to India's 109. Right. All right, Nana. Yeah. So confirm me with respect to the audio quality and everything. Okay. All right, guys. So last session, this is where we have stopped in the sense we have already done sums as well. If I'm not wrong, how many problems we have done, Ray? Question number 5 we did not do, right? We have solved till 4. Okay. Before we continue with the rest of the sums, we have to finish off certain concepts because as you can see, in the last session only I've told you that we have covered only one area of where we deliver our own equity instruments, correct? And then compound financial instruments and so many other concepts are left over. I think if I'm not wrong, this we have discussed in the last session, correct? Only this area we have covered, right? So now we are going to cover compound financial instruments followed by contingent settlement provisions. Then we'll go to this part where entity will receive its own equity, which means it's equity only, but it is with somebody else and you're going to buy it back. So that's where we're going to see what is treasury shares. And in the last session, we have solved a problem based on this concept, return put option on own equity. We have solved it, although we have not discussed the concept, still we have solved it. And then I hope I've explained you pretty well. And then we have buyback as well, which most of you guys have already do have an idea. So 1, 2, 3, 4, 5. This we need to see. In that, the first part that we're going to start is compound financial instruments. Okay, right. Now, even compound financial instruments, if you guys remember the last session where we have done nearly 12 sums, okay, there in few of the problems we have already seen and applied the concept of compound financial instruments, okay. We have already touched this concept many a time. So this is not something that is altogether new for you. You guys should be familiar with this, okay. So basically it's a hybrid instrument where a single instrument consists of two things, correct? So what are those two things? One is you have a liability component, the other one is you have a equity component, right? I told you most of the times there will be a fight between equity and liability, right? Financial liability. But sometimes in a single component, you'll have the qualities of both equity as well as financial liability. In that case, you call that particular instrument as what? Compound financial instrument. Okay. Now, I'll take an example which you have already seen in India's 102. ESOPs with a cash alternative. You guys remember that? Employee stock option plan with a cash alternative. Okay, where we'll be doing accounting keeping SARs in mind. Okay, then eventually employee will choose. If he wants, he can go for, equity shares option. That is nothing but ESOPs. If he wants, he can go for SAP. You guys remember that? Where for SAP, the number of shares will be less. For ESOP, the number of shares will be high because it comes with a restriction where for next 3 years, you should not sell it. Whereas when it comes to SARs, it's all about giving cash. So it does not come with restrictions. Therefore, the number of shares will be less. And employee has got an option to choose whether he wants ESOPs, he can go for ESOPs, or he wants SAR, he can go for SAR. That is nothing but ESOPs with a cash alternative. That cash alternative is nothing but SAR, correct? This entry also we used to put employee compensation or employee benefit expenses debit to SBP reserve, SBP liability. SBP reserve is for ESOPs, SBP liability is for cash alternative. You guys remember that? You remember or you don't remember? That's why I put in this GIF over here. Huh? You remember that? Okay, okay. So here, all these guys, they do remember. Okay, so we have already seen the compound financial instrument. So it is not something that is altogether new for us. Okay, right. So now that you know the concept, now let's try to learn the concept in depth through some examples. Okay, so we have got four cases. Huh? No, yeah. All right. After that, we have contingent settlement provisions. So case by case, we'll try to cover. Ready? All right. Okay, okay, okay. Right now. Okay, enough of cracking jokes. Okay, let's start. Let's continue with the session. So we'll start with case one. ABC Limited issued a redeemable preference shares with discretionary dividend. Now, redeemable preference shares means what? Compulsory, you have to repay, which means there will be a cash outflow, which means there is an obligation with respect to cash outflow, correct? So, when you have an obligation to pay cash, definitely it comes under financial liability, right? With discretionary dividend means if you feel that you have sufficient profit, then probably you'll pay dividend. If you feel that you don't have sufficient profit, you will not pay dividend. So it is in your control, which means you have any obligation to pay dividend? Provided if the dividend is mandatory, then you have an obligation to pay dividend, correct? But when it comes to discretionary, you don't have any obligation to pay dividend. In that case, does it satisfy the definition of equity instrument where you don't have any contractual obligation? Yes, I don't have any contractual obligation. Therefore, discretionary division, that particular part, that discretionary dividend part, we can call it as equity because you don't have any obligation to pay. So, therefore, in one instrument, you have, sorry, in one instrument, you have financial liability as well as equity. So, therefore, it's called as compound financial instrument. Okay. Now, few more things we'll see. Cumulative or non-cumulative preference shares. Cumulative means what? Where the dividend gets accumulated. Okay. So when you have sufficient money, you'll pay dividend. When you don't have sufficient money, you'll not pay dividend. As a result, it keeps on getting accumulated. Okay. So or non-cumulative preference shares where ultimately the payment of dividend is discretionary. Once it is discretionary, that particular part we'll call it as equity. Okay. When you have mandatory dividend, then that will come under financial liability. Got it? Right. Chalo, moving on to case 2. This is a simple case only. Coming on to case 2, Nana. This already we have solved a sum based on this illustration. Irredeemable debentures issued. Irredeemable means you will never redeem it, which means perpetual bonds. We have already solved a sum. I think illustration 3, if I'm not wrong. Okay. With mandatory interest. So mandatory interest means you have an obligation to pay, contractual obligation to pay cash. Therefore, it is financial liability. Perpetual bonds means it is irredeemable, which means there is no way you're going to redeem it. So when you're not going to redeem it, you don't have any obligation to redeem, to pay money, to pay cash. Therefore, that will satisfy the definition of equity. Finally, it is a compound financial instrument. Fantastic. Easy peasy. Now, this concept is easy because already we have solved sums and we have seen this so many times. That is the reason now you guys are pretty comfortable. Okay. Example number 3. Compulsory convertible preference shares at 1:3 with mandatory dividend. Straight away, mandatory dividend means what, Nana? You have a contractual obligation to pay cash, satisfies the definition of financial liability. Therefore, it's a financial liability. Game over. Okay. Compulsory convertible preference shares where the convertible ratio is 1:3, which means for every preference share, let's say we will be giving 3 equity shares. Is it fixed? Fixed. Suppose you have got 1000 convertible, preference shares, then we'll be giving them 3000 equity shares. There ends the matter. That's all. So 3000 will never change. You got the point? Based on any market price or something like that. Therefore, it is fixed ultimately. So once the number of shares is fixed, then obviously it will come under equity. Got it? It will come under equity. So therefore, the compulsory convertible preference shares into fixed number of equity shares will be referred as equity, and the mandatory dividend will be referred as financial liability. Since both are existing in a single instrument, we call that particular instrument as compound financial instrument. Done? Shall we move on to the next one, Anna? Yeah. Case 4. You have convertible debenture over here with mandatory interest. Okay. Now what we're going to do in this particular example is we're going to see it from both the perspectives. From the perspective or from the viewpoint of investor, from the viewpoint of the issuer. Investor is nothing but holder. Issuer is nothing but the one who is issuing the debenture. That is mostly a company. Got the point? Right. Just a second, guys. Now moving on to convertible debentures, we're gonna see it from both the parties. Okay. Now this is really important, Nana. So listen carefully. All right. Now, suppose the conversion option is in the hands of the holder, which means the opposite party. I'm the company. Okay. Always you feel that you are the company. Okay. You have given the conversion at the option of the holder, which means the other guy. Okay. Keep that in mind. Conversion at the option of the issuer. This is more natural, which means it is at the option of the company. Okay. Second one is more natural because it is at the option of the company. Okay. Which means if I feel I can convert this particular debenture into equity shares, otherwise I will redeem the debentures. That's all. You got the point? Conversion at the option of the other guy, the investor or the holder. Now this is a little bit tricky. Okay. We'll try to see both. Okay. You guys are ready? Now let's start with the usual one. Conversion at the option of the issuer, that is company, usually whoever has issued debentures. At that option of the issuer, which is the company, if I want I can redeem, if I want I can convert. Now first of all, forget about the redemption or conversion into equity shares. Okay, one thing is for sure, you're gonna pay interest, correct? Now interest is a contractual obligation to pay cash, so straight away it's a financial liability. There is no doubt with respect to this part. Now coming on to principal redemption, okay, where either you can redeem the debenture or you can convert the debenture into X number of equity shares. Now in this case, it is at whose option? The ball is in whose court? It is in the company's court. Means if company wants, it can convert that into equity shares where it will not have any obligation to pay cash. If the company wants, it need not convert, it can just redeem it. So which means it is at the hands of the company, correct? Which means now you tell me, is there a real contractual obligation on behalf of the company that 100% it has to redeem the debentures? No. Therefore, because the issuer or the company at his own will, according to his wish, can avoid paying cash. How can he avoid paying cash? By converting that into equity shares. Because it is at his option only, na? It is within his control. So therefore, within my control, company's control, therefore I can happily avoid paying cash. Avoid paying cash means avoiding redemption of debentures. Got it? By converting that into equity shares. So therefore, it is within my control. Therefore, there is no contractual obligation for me to pay money for sure, no matter what happens. Therefore, it is termed as equity. So interest is financial liability, principal repayment is equity, because the conversion option is in the hands of the company who has issued the debentures. Okay, therefore it's a compound financial instruments. Clear? So this part is pretty easy to understand. Now come to the tricky one. Now here you focus. Conversion at the option of the holder or investor, which means now the ball is not in my court, it is in the court of the investor. That guys. Anyway, you have to pay interest. That is 100% financial liability because you have a contractual obligation to pay cash. Who? The company. Got the point? Let's say PK Limited is the company. I have to pay interest to the issuer. Fine. Now, with respect to the redemption, as a company, now please try to understand, this is important. As a company, right now, I don't know whether the investor will choose the conversion into equity shares option, or he will just say that no, you just redeem the debentures. As of now, I don't know. Let's say this is gonna go for 5 years, Nana. After 5 years, the holder or the investor, whether he will choose the option of conversion of these debentures into equity shares, or he will say, I don't want to exercise the conversion option. You just try to what? Redeem it. You understand the point? I don't know what he's gonna say. So is it in my control? No. Me, the company, can I avoid contractual payment of cash 100%? No, I can't avoid. Why? Because if the investor chooses to redeem the preference shares without choosing the conversion option, then as a company, I have to pay him cash. Suppose if he chooses the conversion option of converting the debentures into equity shares, then as a company, I'll escape from contractual payment of cash. You understand the point? So ultimately, it is in my hands or in the hands of the investor. It is in the hands of the investor, which means, is it in my control? Is it in company's control? No. Which means as a company, can I 100% avoid contractual payment of cash? No. You can't avoid because it is not in your control. It is in the control of the investor. Therefore, when I can't avoid, when there is a chance of me making a contractual cash payment in future, which today I don't know, but there is a chance of that happening. Again, recollect the magic word which I gave you. It's not about what usually happens. It's not about what most likely happens. It's about what can happen. Here, is there a possibility of you making a contractual payment of cash happening in future? Even if that probability is 1% also, is there a possibility of that happening? What can happen? Can this happen? Yes. In that case, you have to say it as financial liability only. You understand the point? Got it? However, the whole instrument will be called as compound financial instrument. What is this, sir? No, 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 no. Sir, till here the logic is fine. That's why I've written this here. This GIF. How? Tell me. You know? How? Tell me. I know what you guys are thinking right now. Okay, sir. ये तो clear है sir, financial liability. Here also you explained the logic, sir. What can happen? There is a chance of paying contractual or cash flow if the investor chooses the redemption of debentures option. Correct? That is why here also you have written financial liability. This also we have understood. Financial liability, it has to be financial liability only, sir. How can it be compound financial instrument? It can be compound financial instrument provided one is financial liability, the other one is equity instrument. Correct? Here it is financial. In that case, this also has to be financial liability. Na? Why is this compound financial instrument? That is why I've given 3 star marks here and then I've written C below. Your reaction also I've guessed it easily. That's why I've put this GIF here. Okay. Just on a lighter note, Nana, once you'll be going this through, at least you will have a little bit of lighter moments, right? While studying, because anyway, you'll be studying with lots of pressure, right? So keeping that in mind, I've just put all these things. Okay. This is the first version of the book, but then it seems like a first version for you, but then I've written so many times and then I've deleted it and then only I came up with the ultimate version, even though, so I hope you guys can get the value addition of all the hard work that I've done. Anyways, now let's move on with this one. Okay, now see here. What is the logic for this? Here we have the logic is here 3 stars I've put na, that is for this one. So we are still dealing with this part. Okay, despite having financial liability and financial liability over here, why this is called as compound financial instrument? That's what we need to understand, because to call it as a compound financial instrument, you should have financial liability and equity element. Now I don't see any equity element over here. It is there, equity element is there, sir. How there is equity element, sir? It depends upon the option of the investor, na, sir, what he chooses. If he chooses the conversion option, then it becomes equity shares. Then here equity will come. Then this can be a compound financial instrument. But logically speaking, what he will choose today, we don't know. So we applied the usual logical. What is the logic of financial instruments? What can happen? What can happen? Whether he chooses conversion option or he asks you to redeem the debentures, both the possibilities are there. Suppose there is a chance of redeeming the debentures. In that case, you have to pay contractual cash flow. So this can happen. Therefore, once it can happen, automatically it will be classified as financial liability. Then it's a matter. Correct? This thought process is done. Now, my question is, in this case, I don't see any equity element over here. Without seeing any equity element, just by looking at financial liability over here, how can you classify something as compound financial instrument? If something has to be classified as compound financial instrument, it needs to have equity element. Where is equity element? This is your doubt, and I know it. Let me give you clarity for that. Actually, we have solved question number 3, na, illustration 3. In that, this logic is already, it was discussed actually. Illustration 3, here. While explaining this, I've already discussed this logic and I told you that it's gonna come anyway. Okay. Chalo. So some of you already know if you would have caught me perfectly. Right. Okay. Now let's explain and let's see this. Ready? Suppose Nana, investor wants 18%. Okay. Company PK Limited issued these debentures on the same day. Fine. There are 3 options over here. Try to understand this carefully. Investor wants 18% provided it is a pure, normal, redeemable debentures. So redeemable debentures means 18% TK at 18% for 10 years. Got it? Which means what will happen for a period of 10 years, Company PK Limited will make interest payment from time to time every single year. Then after 10 years, they'll go for redemption where they'll repay back the initial money that you have received. You got the point? Yes. So this is plain vanilla. Okay, no twists, no turns. However, come to the second point. Redeemable debentures at 15% only, compulsorily convertible to 10,000 equity shares at year 10. Now, the first question that comes to your mind is, sir, why there is a difference of 18% and 15%? Because going by the risk analysis of this particular company, investor is anticipating 18%. But then you are giving only 15% over here. Yes, I'm giving 50%. Why? Because even though I'm paying 3% less, this investor feels that because there is an option of getting equity shares, you understand the point? That equity value is also there. That will compensate the balance 3%. You understand the point? It might compensate more than 3% as well. Because you are able to get equity shares after 10 years, that value will increase meanwhile. So the investor feels that because of this, even a lesser interest rate is okay, because this is written for this fellow, right? This 15% is cost for the company. The same 15% is written for the investor, correct? Investor will accept a low return because he thinks that the other part of this return which he has missed, in this case 3% he is missing will be compensated by way of market price increase of equity shares, because he is going to get equity shares as well. So therefore he will agree for a lower interest rate because of the option of equity shares compulsory conversion. Clear? Now look at the third case. It is far more interesting. Redeemable debentures are 13% only, even less than these two. Convertible into 10,000 shares, pretty much similar to this one, except here it is compulsory convertible. Here it is at the option of the holder, which means I'm giving more luxury, more options to the holder or investor. So when I give more options to the holder or investor, obviously he should agree for a far less investment return, because I gave you more features now. You understand what I'm trying to say, right? Okay, let me not call this as a holder. Let me call this as an investor. Okay, let me call this as a investor. A second. All right. Got it, guys? Now, so what you have to understand is a plain vanilla debentures where it will be simply redeemed after 10 years, 18% is what the market anticipates. Once you give them an option of equity shares, because I'm going to get equity shares also, market will agree for a lesser interest rate. Now, when I not only give them an option of equity shares, I say it is at your hands. It is in your control. You can choose whether you want to convert that into equity shares or you want just the plain redemption of the debentures. So I gave you a lot of freedom, lot of advantage to you. Therefore, you will agree for even less percentage in that case. Now, so the point that you guys need to understand is, because of equity share option, that is convertible option, interest got reduced from 18% to 15% year to year. And because of the option in the hand of the holder, in the hands of the holder. Okay, holder is nothing but investor. Okay, there is no free lunch, nothing comes free. So here when I am giving option that you can either choose to convert it into equity shares or you can go for redemption option, that choice I'm giving you that choice is not free. Everything will have a cost. You understand the point? The cost is reduced return for the investor. And because as a company I am giving choice, for me I have to, that is also not free it will cost me tomorrow. You understand the point? Because it is an uncertainty. Tomorrow I don't know what this guy is going to do. Accordingly I have to manage all those things. For that, the advantage what I get is reduced interest which I have to make payment. You understand what I'm trying to say? Now, so because of equity share option, interest got reduced from 18% to 15%. And because of option in the hands of the investor, there is no free lunch, which I'm trying to say. So that option also has got a cost. Interest got further reduced from 15% to 13%. So this is CFI. This is CFI. The difference is there 18 to 15% and 15 to 13%. That is equity portion. You understand the point? So therefore, you have equity portion. You have what? The normal non-equity portion put together. We call it as CFI, compound financial instrument. Now come back here. in this case, when the conversion option is in the hands of the company itself, that is issuer, it is a plain vanilla case. Here we told that the interest payment, what he has to do, there is a contractual obligation to pay cash, so it will be classified as financial liability. Whereas when it comes to principal, because it is in your hands whether you want to convert that into equity shares or you want to just redeem the debentures, therefore because it is in your hands, there is no contractual obligation, therefore it is classified as equity. So no obligation to pay cash, although eventually it may pay cash. That will be ultimately your choice, na? You understand the point? Rarely that will happen. If the issue of equity shares is not possible, then only option is to pay cash. Then it may be appropriate to classify as a financial liability. This is a very rare scenario, Nana. Which means what I'm trying to say is that 99% of the cases, when the option to convert your debentures into equity shares is in the hands of the company, 99.9% of the cases, company will convert that into equity shares only. It will not go for cash obligation. However, in certain exceptional scenarios, that's why I've written here rarely, okay, there might be a chance because of some other regulations or government restrictions, issue of equity shares is not possible because of war broke out or because of something else, something would have happened. Therefore, the only option for the company is to pay cash in that kind of situations. Therefore, it may be appropriate to classify as financial liability. You understand the point? Right? It's a rare case scenario, Nana. So this is an exception. Therefore, this you should not remember. This is what you have to remember. All right? Chalo. And I told you the logic for this as well. So even though here in both the cases it is classified as financial liability, when there is an option to convert it into equity shares, because of that you will be paying less interest rate to the debenture holders, and debenture holders will also accept less interest rate because they also know that there is an equity element. When you know that there is an equity element, then obviously it has to be a compound financial instrument. That's why we classified this as a compound financial instrument. The logic is here. Are we done with this? It is invisible. Correct, Nana. Correct, Nana. It is invisible. The equity portion is invisible. Here it is not visible. Here all that is visible for you is financial liability and financial liability. But here you have conversion at the option of the holder or investor. Now it falls under third example which I gave you, where you will be paying only 13%. Where if you don't give this option, you should have paid 18%. Then this difference is indirectly what? It caters to equity part only. You understand the point? Because of giving that conversion option to equity only, you were able to reduce your debenture interest which you have to pay as a company to the investor all the way from 18% to 15%, Nana. So that is the value of equity, na? Sir, how to calculate? Already I have shown you an idea. Hey fellas, you're asking mukku doubts, mukku fellows. Here I have shown you how to calculate the equity. See here. Normal debentures rate is 12%, which means without the equity option. When you give the equity, in this case irredeemable debentures, you have a equity. Why? Because you don't redeem, that is equity. So where you will be paying only 10%. Because you gave that equity option, the investors will accept what? Lesser interest rate. So how to find the equity portion? Very simple. You find out the present value of this cash flow divided by rate of return. So cash flow is 10 because you will be paying 100 into 10%. 10 rupees is 10 divided by 0.12. That is your rate of return for a normal debenture. You put that, you get 83.33. 83.33 is the value of what? Liability, financial liability component. Then actual value is how much? 100. Then the difference of 16.67 is equity component. Already we have seen this. So this is nothing but we call it as invisible equity component. In future we'll solve sums also. Right now just get an idea. Okay. Here itself you write. Here I'll write practical example. The illustration 3. Okay. So tomorrow also if you get any doubt, you see illustration 3, that will be clarified. Okay. Any other doubts, Nana? Before we go to the next topic, any other doubts? Clear? Topics will be very interesting only, Nana. Okay. Okay, this what I've written is same logic can be applied for convertible preference shares, which means same stuff. In the place of debenture, you will just write preference shares, that's all. Everything else, whatever the concepts that we have seen here will be exactly the same. In the place of interest, you'll have preference dividend, that's all. You understand the point? Of course, here when we try to calculate preference dividend into financial liability, it has to be what? Mandatory preference dividend. If it is discretionary preference dividend, we already know it will also be classified as equity, correct? Remaining is same. Even preference shares also will be convertible into what? Equity shares. So the concept exactly remains the same. That's what I've written. Same logic can be applied for convertible preference shares, which means whatever you have written here, exactly the same. Only thing is that the name will change. In the place of debenture, you'll have preference shares. In the place of interest, you'll have preference dividend. That's all. Got it? Okay. If you guys are done with this, then we'll move on to the next one. That is contingent settlement provisions. Okay, I'll wait. Any other doubts? Any other doubts? All right. Shall we move on to the next one, guys? All right. Now, so contingent settlement provisions. So far, we have seen two things where an entity has to issue its own equity instruments. In that, one that we have covered is fixed to fixed test. Under that, the other one that we have covered is compound financial instruments. Compound financial instruments is not altogether new except for the last case, that is case 4. The rest of the things were relatively simple. Only in the last case where there is invisible equity element which makes it a compound financial instrument is the only, tricky part probably. Apart from that, everything else is quite a bit normal. Okay. Now moving on to this one. What is this? Contingent settlement provision. In short form, we'll call it as CSP. Right. Now let's start with the definition first. So what is a contingent settlement provision? Name itself tells you contingent. Contingent means may or may not happen, right? So therefore, suppose any financial instrument, for that case, financial instrument means it can be a financial asset, a financial liability, or an equity instrument. Any financial instrument may contain a provision. It may contain what, Nana? A provision that requires the issuer who has issued the financial instruments, the one who has issued, for example, debenture holder is an investor, the one who has issued the debenture is the company, okay, that requires the issuer to deliver cash or another financial asset, that is settle the instrument only on the occurrence or non-occurrence of a future uncertain event. So usually, for example, redeemable debentures is there. 5 years redeemable debenture. Now tell me, that redeemable debenture, is it a financial instrument? First of all, it's a financial instrument. From issuer's point of view, I have issued debentures, right? Which means somebody gave me money and they took the debentures, correct? I have to make them interest payment every single year. So it is a financial liability for me with respect to the interest payment, correct? If it is compulsory redeemable debentures, then let's say after 5 years, I have to redeem the debentures. Correct. That also becomes financial liability. Ultimately, this will be a financial liability in both the cases, okay? Because there is contractual obligation for you to pay cash. Now, tell me one thing. Here, when you say it is a 5 years redeemable debentures, when you're issuing, it means no matter what happens in this entire world, after 5 years, you have to redeem the debentures for sure. Correct? This point is clear, I think so. So, no matter what happens, ultimately, you have to eventually redeem the debenture. Correct? However, suppose this way, that redemption will happen if and only if based on occurrence or non-occurrence of certain event. Suppose if there is a war happens, then only I'll redeem the debentures, or if war happens, I will not redeem the debentures. You understand the point? This much profit comes, then only I'll redeem the debentures. Otherwise, I'll not redeem the. Like this, there is some sort of a condition linked to the redemption of that particular financial instrument, where that particular condition may happen, may not happen. Occurrence or non-occurrence of a particular, future uncertain event, right? That is nothing but we call it as a contingency. That is beyond the control of both the issuer and the holder. This is very important. It should be beyond the control of both the issuer or the holder. Yeah. I know. Immediately they've asked me doubt. Sir, you're talking about the profit now, sir. Profit should be in the control of the company. Yes, it is in the control of the company only, most probably issuer. But still, there are certain elements which will be outside the control also, Nana. Okay, right. Anyways, so that's the definition. So at the end of the day, what is a contingent settlement provision? A particular financial instrument may have this sort of a provision where the so-called obligation to deliver cash or any other financial asset will be dependent on occurrence or non-occurrence of a future event which is uncertain. You got the point? And that event is not in the control of both the issuer and the holder. This is very important. Okay. So that uncertain future event, whether it will happen or not, that is nothing but contingency. That's why we call it as a contingent settlement provisions. Okay. Okay, sir, that's fine. Okay, so this is what the story is. Now my question is very simple, sir. Why is it relevant for us when it comes to financial instruments chapter? What does India's 32 say? You tell me that. Why are we studying this first of all? You tell me that. What is the context with respect to our syllabus? Well, the answer is now we need to find out whether this so-called contingent settlement provision is a liability or equity. Again, same issue. Always the fight will be there between financial liability and equity. In Tamil Nadu, there is a program, I think, which TV that is, I don't know, Niya Nana, like that. Always there will be a fight. Like that, this entire chapter, most of the times, you'll have a fight between liability or equity, whether it's a financial liability or it's an equity. Got the point? Anyways, okay, now, okay, to find that, now ask yourself, means question yourself, okay, is the issuer obligated to settle in cash or financial asset? If he's obligated, naturally it will be what? Financial liability. If he's not obligated, it will be a equity. That we know already, isn't it? Let us see. Yes, he is obligated. Then even if only under certain condition, even if it is contingent, still it is financial liability. Why? Because again the golden rule. What can happen? What can happen? It's not what usually happens. It's not what most likely happens. Suppose you come out with an argument saying that, sir, there is a contingent provision with respect to war happening. If war happens here, some sort of an obligation, cash payment will happen. Otherwise, it will not happen. Now, you say that, sir, the war obligation is, let's say, 20% or 30%, the probability of war happening. In that case also, we'll classify that as a financial liability only. At least the 20%, 30% chance is happening. Na? You got the point? Of course, for this, there is an exception, especially in a case of war, that we will discuss later. Right now, that's a basic understanding. Okay. So, if the answer is yes, if the issuer is obligated to settle in cash, obviously there is a contractual payment, contractual obligation to pay cash. Definitely, it will be a financial liability, even though it is contingent. That's what he's trying to say. Even though it is contingent, means may or may not happen, because you can't predict the future, right? But there is a chance of that happening, right? Suppose if it happens, you have to pay cash, right? Therefore, it is financial liability. Clear? Suppose if settlement is only optional, or in the issuer's own equity also you can give fixed number of equity shares, then it will be classified as equity. And here also look at the important point. Specifically, I've mentioned that the number of shares must be what? Fixed. Only then it will be classified as equity. Or the cash settlement option is optional. Optional means what? At my discretion. At my discretion, at my company's discretion. In that case, can I avoid payment of cash? Yes, because it is at my choice only. Now, if I want, I'll pay cash. Otherwise, I'll not pay cash. In that case, this will be classified as equity because you don't have an obligation to pay cash, which means you can avoid paying cash because it is at your choice. The moment there is a chance of avoiding paying cash, then automatically it will be classified as equity. That's what we are trying to say. Clear? Right. Now, all right, Nana, let's move on. Now let's look at the logics of the standard. Standard's first logic is always this standard follows not only the standard, Nana, every index for that matter, substance over form. Even if the instrument appears to be equity, in substance, if the issuer might have to settle in cash, it will be finally classified as a liability. Name will be equity only, but you will classify that as a liability. Substance over form. The form is equity, substance is liability. Finally, we'll classify that as liability only. You understand the point? Similarly, in this case, even though the name is debentures, even though the form is debentures, you understand the point? But here we have classified that as equity only. Na? Suppose even the interest is also discretionary interest. There is no mandatory payment of interest requirement. In that case, this will also be equity. This will also be equity. In that case, this will not be a compound financial instrument. It will be what? Equity instrument only. But what is the name of this? Debentures. Debentures means straight away what will come to your mind? Array, it's a liability, na yaar. But here we have classified that as what? Equity. Because the form is debentures, but the substance is equity. In this example, the form is equity, but the substance is liability. You understand what I'm trying to say, right? Next, second logic of the standard, protecting investors. What do you mean by protecting investors? Contingent settlement provision is not about what usually happens. It is about what can happen. This we have already seen, the golden rule of this particular standard. Even if there is a slight hint or possibility of cash flow outside company's control, then it will be classified as financial liability. Because there is a possibility of that happening only, na? So suppose if that happens in future, then definitely there will be a cash outflow. So therefore standard says that you tell this to your investors. saying that, okay, I'm classifying this as a financial liability. Your investors also will understand. Suppose you don't tell this to investors and then you classify that as an equity, then your investors will have a different perspective. Na? Equity means there is no contractual obligation, so therefore liquidity of my company is really good. You understand what I'm trying to say? But suddenly, if there is this kind of event happens and then all of a sudden the company has to pay cash in future, then suddenly there is a liquidity crisis for the company, then investors will get hurt. Market price might go down. Why? Because liquidity crisis means where you have an obligation to pay cash and you end up not paying cash, saying that I have assets, I have cash in another form, but I don't have cash in cash form. That we call it as a liquidity crisis. So when you don't have cash in cash form, you can't pay your short-term obligations. When you can't pay your short-term obligations, then that name will immediately spread in the market in the sense where your companies are. You understand the point? And that will hurt your market price, and market price will suddenly drop, and that will hurt all your investors. You understand the point? So this much bigger game is there. That is why your standard says, to protect the investors, I will look into the substance, not the title, not the form. I will see what it actually means. I'll lift the wheel and then I'll see what it actually is. I'm not looking at your titles. You may have a title as debenture, but if I feel that it has the qualities of equity, I'll classify that as a equity. You may have a title as equity, but if I find the qualities of a liability, I'll classify that as a liability. I'll treat it as a liability. I'll account it as a liability. I'll show it to the investors as a liability in the form of your financial statements, where investors will see that. Isn't it? Yes. Chalo. So that is the reason. Why are we doing all these things? I gave you two reasons over here. Got it? Okay. Now till here we have seen 4 cases, na? Correct? Now let's look at one more example. Ready? Case number 5. Yeah. X Limited has issued debentures for 5 years on the following terms. Debentures are converted into equity shares in the ratio of 10:1. Okay. Which means for 10 debentures, 1 equity share. Okay. What is the condition? If the fair market value of the share is greater than 100. Otherwise, it will be redeemed in cash. Oh. Now, tell me one thing. Otherwise, it will be redeemed in cash means what can happen? It's about what can happen. There is a chance of redeeming in cash. Na? Suppose if the fair value of the market value of the share does not cross 100. In that case, you have to redeem in cash. Therefore, this will be classified as financial liability. Got it? Done. Next. The debenture are converted into 10 equity shares if the market price is greater than 100. Otherwise, it will be converted into 15 shares. Now, you people tell me what you will do here. Shares only, na? Can I classify as equity? No. You can classify it as equity provided it should satisfy the fixed to fixed test. Fixed number of shares. Is there a fixed number of shares situation over here? 10 shares if it is greater than 100 market prices. Otherwise, you have to give 15 shares it seems. So therefore, even though the settlement will happen by issue of shares, the debentures cannot be classified as equity since the number of shares is not fixed. When the number of shares is not fixed, it is not satisfying fixed to fixed condition. Therefore, it will be classified as financial liability. Got it? Chalo. The debentures will be converted into equity shares at 5:1 only when the market price of the share is greater than ₹100. The debenture issue will be classified as equity instrument since there is no possibility of making. Okay, otherwise sentence is not there. You see, the difference between this and this is what, Nana? You see here, equity shares in the ratio of 10:1 if the fair market value is greater than 100. Okay, here also same thing, market price of the share should be greater than 100. But here, suppose if it does not happen, it will be redeemed in cash. Do you have that sort of a sentence in case 3? No. Which means there is only one choice. You will wait till the market price of the share crosses 100. It may happen in second year, third year, fourth year, fifth year. Once it touches 100, you will convert that into fixed number of equity shares. So therefore, is there a chance of contractual obligation? No. Ultimately, when you will convert that into equity shares, that may happen in third year or fifth year or sixth year or whichever year where this 100 will be crossed, correct? But here that's not the case. If that 100 is not crossed in a specified time, you have to convert that into cash. You understand the point? You have to redeem in cash. Therefore, there is a chance of contractual obligation of payment of cash, right? Therefore, it has been classified as financial liability. Same logic happens here also. Of course, in this case, it is about equity shares only, but they are not fixed in number. Therefore, it is financial liability and not equity. In this case, it is fixed in number. and there is no otherwise sentence. So therefore, at the end of the day, you will, you'll be making a fixed number of equity shares payment. You understand the point? You'll be giving them fixed number of equity shares. So therefore, fixed to fixed condition is satisfied, and there is no otherwise point of, payment in cash. Therefore, this will be classified as equity. So finally, this is equity instrument, this is financial liability, and this is also financial liability, and this is equity instrument. Clear? Yeah. Correct only, Nana. Your thought process is correct. Okay. Moving on to case 6. Preference shares redeemable in equity shares, but if war breaks out, it will be settled in cash. This is what I've told you. Okay. So the war is nothing but a contingent settlement provision. Correct? Okay. Now let's try to understand what is the situation of war. Is it beyond the control of the holder and the issuer? Yes, it is, obviously. And then you have to see how your country is. Is it stable or unstable? Is it frequently affected by war, or is it mostly unaffected by war? These things you have to figure it out. And after that, depending upon that, you will make the classification over here, because war is a very peculiar condition. See here, your country is stable, like India, for example. War is very rare. Then you know that the probability of that happening is absolutely zero. Here, don't come out with the logic that, sir, what can happen? You said that if even war probability is happening 0.1% also, there is a chance of happening that na. Therefore, let me classify that as a financial liability. In that case, when the moment this condition is there, every country, there is a chance of war breakout. No matter how peaceful the country is. You understand the point? Maybe the probability will be, in some countries it will be 1%, in some countries it will be 0.1%. In that case, eventually what will happen, every country has to, eventually classify this as a financial liability. No, that will not happen. Okay, so therefore we look into the general circumstances. Is it a war heavy country, or very rarely war will happen? If it's a war heavy country, like for example Israel for that matter, and America, our own America, okay, if these kind of countries, obviously they'll get into one war or another. Especially America is a war based economy, correct? Whenever you see the pattern, whenever they feel that their debt is really high, they'll create a war and they'll enter. Ultimately, all this Lockheed Martin and all these war making machines companies stocks will rise up, and eventually they'll prove their those war equipments and fighter jets and all that. Their market price will increase, and eventually other countries will order them, and that's how their economy gets back into track. Anyways, these are all geopolitics. Let's not concentrate on that. Automatically my UPSC things are coming out now. The point is, I can't control it. uh, so if it is a war mongering or war hungry nation, then obviously you'll be that most probably war might happen. Therefore you classify that as a financial liability, because if war happens, you have to settle it in cash. But if it is a country like India, where we never go to war for on anybody, right? Always, if you look at the last 1,000 years history, everybody comes and kicks us, and then it goes out. Eventually that's what happens. So absolutely, in our case, we never start war on anybody. We never initiate anything. We always get kicked first, and after that also we don't initiate most of the times. So we are on the other side, other extremity. Anyways, so therefore it will be classified as what, Nana? Equity. Got it? Chalo, done. All right, so with this, we are done with all the three important concepts where an entity has to issue its own equity instruments to settle. They are, first one is fixed to fixed test, second one is compound financial instruments, third one is contingent settlement provisions. Clear? We're done with this. Okay, so far, do you guys have any doubts? Okay, because after that, we'll go to buyback and all the other things. Okay. We have buyback, then we have treasury shares. Okay, then we have accounting for equity instruments and stuff. Then foreign currency convertible bonds, puttable financial instruments. I think share swap arrangement should be there after this. Yeah, share swap arrangements. Then we'll be done with India's 32. Okay, it will take some time. After that, we'll solve those 13 sums which is left over. Then 25 sums will be done. Once those 25 sums is done, then we'll get into India's 109. Still, we are in financial instruments chapter only. We are not coming out of it. Okay, but then we are just discussing the concepts. Now, till here it is clear. Any doubts? If you have any doubts, you ask me. No, sir. No, no, no. Okay. All right then.